Welcome to the Seventh Sovereign Wealth Fund Virtual Conference. Before we get started, I would like to go over a few housekeeping notes. We will be muting all attendees during the session. If you would like to submit a question, please place them in the Q&A box, and we'll be happy to address as many as possible throughout the day. Also, this event session will be recorded for archival, educational, and related promotional purposes. If you choose to participate in the discussion, you are presumed to consent to the use of your comments and your image in the recordings. If you do not wish to be recorded, please contact the event organizer. By attending or participating in this event, you are giving consent to be photographed and/or video recorded, and you are waiving any and all claims regarding the use of your image by the Kogod School of Business. The Kogod School of Business will, at its discretion, may provide a copy of photos and footage upon written requests. Please also remember the Chatham House rules. Participants are free to use the information received, but neither the identity nor the affiliation of the speaker, nor that of any participant may be revealed. And now, without further ado, we will proceed with the program and hear remarks from our Dean, John Delaney.
Hello, everyone, and welcome to the 7th Annual Sovereign Wealth Fund Conference, sponsored by the Kogod School of Business. We're proud to be one of the only universities in the United States hosting an event that focuses on these influential state-owned investments. And although we can't be together at Kogod this year, I hope this Zoom alternative will provide you with an equally compelling few hours of valuable information. I also imagine we've all become rather proficient at Zoom these past few months. In fact, I'm pretty confident that this is one of the only pieces of software I know more about than my college senior daughter. By bringing together expert speakers, panelists, and guests from around the world each year, we hope to bring more attention to this often misunderstood field of investment and empower attendees to educate others about the importance and potential of sovereign wealth funds. According to the Sovereign Wealth Funds Institute, worldwide sovereign wealth funds assets totaled $7.7 trillion in 2019. That's no small part of the global economy. And just like every other aspect of the economy, sovereign wealth funds have been affected by the COVID-19 pandemic. A sharp drop in oil prices, in addition to governments providing their citizens and businesses with stimulus checks and loans, has contributed to a growing budget deficit in countries with sovereign wealth funds. Governments always prepare contingency plans for the unexpected, but no government was prepared to deal with such a globally devastating disease. During the conference today, our distinguished speakers and guests are going to explore the resiliency of sovereign wealth funds during this turbulent time, assess the impact of the pandemic, and reimagine sovereign wealth fund approaches in 2021 and beyond. I wish all of you good health and much success, and sincerely hope to see you in person at the 8th Annual Sovereign Wealth Funds Conference at the Kogod School of Business next year. Thank you.
and good morning. My name is Jeff Harris. I'm a co-sponsor of the conference with Dr. Naqshbandi, and I'd like to move the conference forward. Thank you for all attending this morning, and we'll move on to having some words of greeting from our Deputy Senior Associate Dean and Professor of Management, former Chairman of the Management Department, Parthaban David.
Thanks, Jeff. On behalf of the Kogad community, I want to welcome you all to the 7th Sovereign Wealth Fund Conference. I want to thank all of our guests, our noted business professional and industry leaders. We wish we could have met in person as in previous years, but we certainly appreciate your joining us virtually during a busy and uncertain time. We are excited to facilitate a space for this continued exploration and to promote sovereign wealth funds as an important financial and economic issue. Hosting today's conference fulfills a broader purpose, supporting our educational mission by sharing information on this key topic with our community. The collective wisdom of the presenters and attendees help us all more deeply understand the important role and impact of sovereign wealth funds, especially in the context of resiliency during these turbulent times. Thank you again for being here. I would like to acknowledge the leadership roles of Professor Riyad Naqshbandi and Professor Jeff Harris in organizing this important conference and making it an ongoing feature of the Kogad School of Business. Thank you.
Good morning. My name is Riyad Naqshbandi from the Kogad School of Business, American University. Excellencies, distinguished guests, speakers, panelists, honored guests, and colleagues. As our Dean and Senior Associate Dean noted, we are very happy to have you at American University. We are going to have an excellent day dealing with a very important topic. And it is unprecedented issue that we are going to discuss along with the use of a new technology of virtual meeting. We are all looking forward to have a very informative and productive session. Timing of this conference is crucial and from several fronts. Firstly, it comes at a time by which the world is experiencing a dangerous pandemic that we have never experienced before since 1918. In addition to that, we have several challenges, including economic, financial, social, and educational. Mind you, the trade war between the US and China is still on. The IMF forecast for economic growth is gloomy, and wealthy countries are going to the international market to borrow against their natural resources. The IMF predicts that the global economy will contract by 4.9% this year, 1.9% percentage point below the April 2020 World Economic Outlook forecast. Secondly, while the sovereign wealth funds were energized to a certain degree in the past, but now they are facing new reality. From the decline in prices of natural resources, an increase in the state budget, shocks in their national economies, shrinking in the economic growth and demand on the government to provide social network. This is especially true in countries by which their citizens are accustomed to receive government support, subsidies, and care. Since the start of the pandemic, there was a shift in investing in the emerging market, which I think is going to be temporary until the global market recover from the aftermath. The move towards more diversification in the oil producing countries is still on course. Thirdly, while the assessment is still in the making, but there are movements in the sovereign wealth fund space that are a departure from the standard norms, i.e. shifting from a long-term investor to investor looking for opportunities which may or may not have a higher risk. Just to give you a quick general survey, as you know, the S&P 500 monthly return showed fluctuations from minus 12.51% in March to 5.4 in July. It dipped again the negative area of minus 3.92 last month of September. With national economies suffering from revenue shortages and population need for additional government support to mitigate the impact of the crisis, sovereign wealth funds have in many cases seen their role transform. Renewed interest in having sovereign wealth fund in the United States was raised by Professor Joseph Stiglitz, and for a good reason. And by the way, back in 2016, we had a keynote speaker who was talking about having a sovereign wealth fund as a quick remark. To benefit workers and businesses in the country, which is the basic purpose of the creation of sovereign wealth funds. As it was envisioned more than 70 years ago by the late His Highness Sheikh Abdullah Salim Sabah, when he established the Kuwait Investment Board in 1953 in the city of London, and after Kuwait gaining its independence in 1961, the Kuwait Investment Office, KIO, in 1965, which was followed by the establishment of KIA as a parent organization in 1982, when the visionary and renowned His Excellency Abdul Latif Al-Hamad was the Minister of Finance. The theme is the 21st century pandemic. How resilient are sovereign wealth funds? What is needed is to figure out how the fund managers reacted to the pandemic. Did some went ahead and liquidated some of their assets? Also, it is worthwhile to assess to what extent the government help impeded sovereign wealth funds. How about the investment guidelines? Have they changed, modified, or stayed as they are? For sure, the future is going to be different. To what way? It's going to be different. Are these funds going to assume more risk, get involved in risky sectors? What happened to the San Diego principles? Are they being implemented and followed? Are sovereign wealth funds considering some sort of cooperation among themselves? Or they are still competing against each other, including other investors to acquire trophy assets? Finally, there's a possibility that sovereign wealth fund will become another department within the central bank, noting the legal and international ramifications. We are going to address these issues under two panels. One is going to deal with the sovereign wealth fund in crisis, and the other sovereign wealth fund post-crisis. So in short, we are hoping to analyze the impact of the current challenges and then assess its impact on sovereign wealth funds and see who are the newcomers to that important space in finance. What is the impact of sovereign wealth fund on the world economy? In general terms, it does exert a stabilizing effect on financial market, keeping in mind that they are not leveraged. According to the Sovereign Wealth Fund Institute, there are about 122 sovereign wealth funds in the world. The latest statistics in the last couple of days, the total is about 7.8, 7.9 trillion dollars. According to the Sovereign Wealth Fund Institute, almost 41% of the Sovereign Wealth Fund are in Asia, 35% in the Middle East, especially in the GCC countries, 70% in Europe, while the rest in other parts of the world. The largest 12 sovereign wealth funds are located in China, Norway, UAE, Qatar, Kuwait, Saudi Arabia, and Singapore. And now, if we take the data based on countries, China obviously comes first, followed by UAE, because UAE has more than one fund, the same like Singapore and so on, and Norway. So UAE is number 2, which is usually overlooked in the literature, followed by Singapore, Kuwait, Saudi Arabia, and Qatar. When we talk about oil prices, obviously, there was a great shock that the oil prices went from $63 per barrel back in January to 32 in March at the start of the COVID, followed by a drop to $18 last April. The price recovered since then to about $43 this morning, October 14, 2020. So to put it simply, as the Reuters mentioned, it has probably the most destructive sell-off since the Great Depression. And as Reuters mentioned, that $12 trillion has been wiped out of world stock market. The point is, sovereign wealth funds are reacting to these challenges by modifying their asset allocation and indulging in alternative classes, engaging in joint ventures, and focusing more on risk management. Now, going back to some needed announcement, we are going to start our keynote with our keynote speaker, His Excellency Ahmed Sayed, Minister of State, Chairman of the Board of the Free Zone Authority in the State of Qatar, followed by Mr. Abdel San Diego, CEO, CIO of Fonde de Ahorro de Panama, followed by Dr. John Duke Anthony, founding president and chief executive officer of the famous and noted National Council on U.S.-Arab Relations. That will be followed by Mr. Charles Cohen, the Deputy Division Chief of Monetary and Capital Markets Department, International Monetary Fund. Finally, we are going to watch and listen to an interview with Professor Michael Spence of Stanford University and Nobel Prize laureate. The first panel, here we have distinguished panelists from Global Sovereign Wealth Fund, Kuwait Investment Project Company, Squire Patton Boggs, Siena Capital, and from Sovereign Wealth Fund Advisory. And after a short break, we are going to have the second panel from Sovereign Wealth Fund Institute, Hafizi Capital International Consulting, Kogod School of Business, and all compliance services. So many thanks to reserving the titles, Amir Tamimi, Jeffrey Davis, Babak Hafizi, Archana Hingorani, Diego Lopez, Michael Modell, Karim Naqshbandi, and Michelle Noel, William Allen, and Timothy Timora. The conference organizer, Professor Jeffrey Harris, will provide the conference closing remarks. Finally, I will announce the conference adjournment. Now, I would like to acknowledge the generous support from our friends, the Embassy of the State of Qatar and His Excellency Sheikh Mish'al Al Thani, who continued his support since the inception of this conference, the Embassy of the United Arab Emirates, and His Excellency Ambassador Youssef Al-Ateba, a special friend and supporter of the conference, Kogod and American University, who usually attend when he is in Washington, His Royal Highness, Prince Abdulaziz bin Talal Al Saud. That's in addition to the steadfast support from Kogod School of Business and American University for making this conference possible and providing all the help and support that's available and needed. I would like to express my sincere gratitude to our distinguished keynote speakers and panelists who have shown up deep interest and support for this conference over the years. From American University, a special thanks go to the conference co-chair, Dr. Harris, for his encouragement and engagement and for his intellectual contributions by raising interesting questions to be included in the agenda and work diligently in planning this conference. The conference could not be possible without the support of my colleagues, Elizabeth Thomas, Ali Yaris, and Carrie Moscal under the leadership of Assistant Dean Katia Popova and many others, including the dedicated and wonderful volunteers from across campus, including Alina Butt and other volunteers as well. The conference coordinator, Robert Brockmeyer, deserves a special thank you for helping in the planning and execution and keeping everything in order and making sure that we can proceed smoothly. Finally, I would like to thank our 16 plus guests from all over the world for attending the 7th Sovereign Wealth Fund Conference, and would not have that possible without your enthusiasm and encouragement. We are going to record these sessions as my colleague Elizabeth Thomas mentioned. Thank you for listening.
Shall we start? Good morning, everyone. I would like to start by thanking Professor John Delaney, the Dean of the School, and the Professor Ghayath and the team at the American University Kodak School of Business for their invitation. It's always a pleasure to be with you at this event. I wish if I can do it in person, but the COVID-19 impact also impacted this situation. Otherwise, you know, it will be a pleasure to back to Washington, D.C. again. So as Dr. Ghayath mentioned, the sovereign wealth fund industry has been impacted by COVID-19, and the impact is globally, especially the IMF predict the global economy will contract by 4.9% this year, down from a growth of 2.9% in 2019. While the World Bank at the same time has forecasted a fall of 5.2%, the worst contractions since the Second World War. This, of course, you know, has created a threats and opportunities in the sovereign wealth fund industries. So some of the funds need to offload investment in order to support and generate cash to support the local government budget or needs, while the other funds, you know, see it as opportunities to buy at the downturn. Moreover, the SWIFT, which has an economic development angle and focus in sectors such as technology and the new economies, provide to be more resilient and have showing a good return during the pandemic. Hence, worldwide, we are seeing that SWIFT are starting to play a more crucial role in helping and facilitating economic development. And that's very important, you know, transition here from pure financial player to more, you know, economic development player. In Qatar here, we have created a QIA in line of the 2030 vision to focus on economic diversification and to create a diversification of income to the country. And Qatar moving ahead with the 2030 vision, and we are trying also to move from a commodity-based economy to knowledge-based economy. Therefore, we have decided also to position Qatar Free Zone as a global hub for innovation and doing business. We have focused on diversifying our economy via attracting emerging technology and the new economy businesses and link them with the private sector and create joint ventures. As part of this effort, we have also established Qatar or Doha Venture Capital Fund, DVC, as Economic Development Sovereign Wealth Fund. The fund that I chair and managing director, managing the fund, the day-to-day operation business. DVC is an investment fund which intend to support the economic activities and the overall ecosystem within Qatar Free Zone and Qatar in general. Therefore, the fund will invest in small and medium innovative companies globally in order to attract them to set up a substantial presence utilizing Qatar Free Zone as a global hub of business. DVC's companies appreciate and value our strategic long-term commitment and leverage our expertise and wide network globally and locally. This investing model over a long run will create cluster of substantial industries within Qatar Free Zone and Qatar in general, and will generate, at the same time, an attractive return. Moreover, I would like to add that with technology, a new economy, and innovation is the focus space of DVC, the fund has managed to cope well with COVID-19 impact as demand for technology went up and some of our portfolio companies realized a higher revenue. We can see the rising demand for technology affecting both the public and the private space. As you are all aware, the Nasdaq has been up more than 30% year to date due to the increase of the technology company share price. Finally, I would like to conclude that sovereign wealth fund model need to expand the fit of the economic objective of the fund, moving from only financial to more financial and economic development objective. Seeking only financial performance, not always the optimal solution to the problem of utilization of the wealth. Thank you very much, and happy again to be with you today.
Well, thank you, His Excellency Al Sayed. It's a wonderful time to start off the conference with people who are on the ground and doing things actively within the Sovereign Wealth Fund realm. Sitting in campus at American University has been a tremendous opportunity for us to host this for 7 straight years. And your insights are always welcome, and it's wonderful to have you with part of the program. We're moving on now to our next speaker in our next keynote address, Mr. Abdiel Santiago, who is the Secretariat, as Riath had said, of the Fondo de Ahorro de Panama, another person working on the ground, actively managing funds for the betterment of their country. Mr. Santiago, the floor is yours.
Thank you very much, and thank you, Dr. Naqshbandi, for the invitation, the Kogod School at American University, the Dean, and I am very happy to share this stage or screen with such accomplished professionals. This is, I believe, my second invitation to speak, and so I was happy that last year went okay, and you guys decided to invite me again. So I didn't mess up, and I will take that. So the topic today, and I think I have about 15 minutes, so Dr. Naqshbandi, feel free to interrupt me. You can force me to stop, it'll be okay. But the topic today is about how COVID and its impact has threatened the strategic asset allocation of Sovereign Wealth Fund, and what does that mean for how we manage our investments objectives into the future. So I have a couple of observations. And the first observation is that in my view, the experiment of the Sovereign Wealth Fund worked, given the crisis. Sovereign wealth funds are, in a basic sense, a rainy day fund. And in 2020, it rained, and it is still raining. So the collapse in demand stressed state budgets to extreme levels. Those governments that were able to print money did. Those that couldn't borrowed. And when the market, by way of the fiscal response that we have seen, is willing to give you free money, what you do as a country, you take your truck, you back it up, and you fill it up. That's what we have seen over the last couple of months, where we've seen a lot of issuances. So if there's ever a time to get in debt, I would say it is now. But I did want to take a detour a little bit because I think, you know, we're still going through the pandemic, and I think that there's still a lot of suffering going on. Not only the folks that are been directly affected by the disease, but also those that need to go out on the streets and earn their living. And this is especially the case in Latin America. The lady that sells flowers on an intersection in name your city in Latin America cannot work from Zoom. They have to be out there. And so this sort of brings me to this conversation that we have been, hearing over the last couple of months about this alphabet soup of economic growth trajectories. And I think there's a letter in the alphabet for each of those. And so I will share this screen. It doesn't allow me to share, so if you guys can allow me to share, but I'll continue. I happen to be more on the camp that this is a quote unquote K recovery. And a K recovery, okay, I'm able to share now. And I'm going to use the US as an example. The K recovery, this doesn't really look like a K, but I think it kind of does if you really think about it, where you essentially see that the upper line in terms of workers with more education are doing just fine. And as you head down, you see those workers take a much longer time, and there are still doubts as to when that recovery will happen for them. So I'm showing this because I think, and even though this is a U.S.-centered picture, and we do invest as a fund, we do invest in developed markets, mainly the U.S., and so the U.S. is very, near and dear to our hearts when it comes to what happens from an economic standpoint. I think the same thing could be applied to countries around the globe, and those countries that are not as prepared, don't have the infrastructure, don't have the education, will take longer to spring back or come back, no matter how much they borrow. And so, in staying with the Latin America focus, because again, this is an area, this is a region that I represent, that I come from, and it's very important. I think this pandemic has shown the extreme suffering that was on the surface, and now it has bubbled up to the top. What I have here is this picture here, real quickly. It just shows poverty and extreme poverty, and what you see here on the poverty side, on a percentage growth basis, that has grown because of the pandemic around 35%. And if you go on the right and you take extreme poverty, that has grown on a percentage growth basis around 50%. So the numbers are staggering. And that brings me basically to my sort of second conclusion, and that is that the time is now for countries, and again, especially in Latin America, to think or to start thinking or to create a sovereign wealth fund. I'm going to reference it as the FAP, the Fondo de Ahorro de Panamá, which is our sovereign wealth fund. The FAP is, I would argue, and you have experts here. You have Michael, and you also have Diego, who are experts and look at this stuff every day. But I would say that the FAP is probably the only true sovereign wealth fund in the region with respect to its corporate governance and how the fund is designed. And that's a pretty lonely situation to be in when you're the only sovereign wealth fund in the region. So I've always been an advocate for the region to create some of these vehicles. And so the time is now. I mean, that you don't have to wait as a country to wait for the perfect time when you have budget surpluses, when you have all these different things, and then go ahead and create a fund. That's not going to happen. You have to sort of do it now. And the reason why I say that, and that's sort of my second conclusion, is because I do believe with the comments, with the comments from His Excellency and also Dr. Naqshbandi, that sovereign wealth funds are a great vehicle because of their mandate, because of their professional management, because of their corporate governance, to utilize for economic recovery in a lot of cases, and especially in Latin America. If for the region, for our region here in the Americas, is truly an opportunity. There are a lot of trends that are happening because of COVID and even prior to COVID. But I would say two of them is, number one is the onshoring. The pandemic and the effects have basically uncovered a situation where the supply chains probably need to be shortened. And what better place than Latin America to sort of expand that? I mean, a country that is receiving investments, their people are going to do better. They're going to be happier. They're going to be less need to emigrate out of their country for economic reasons. And so, what a great vehicle to have a sovereign wealth fund to sort of push that growth. And that takes me to another point that His Excellency just mentioned, and prior Giyath as well, was, I think the holy grail in terms of sovereign wealth fund is collaboration. And I think we've seen some of that in a couple of instances over the years, but really getting these entities together to invest in one and in each other's countries, it's really an opportunity there, and really something that I hope that happens more frequently. And again, the issue of onshoring is another great a catalyst for that to happen. The second point, just in terms of the opportunities in the sectors, is infrastructure. And when we always talk about infrastructure, and in this example, I think infrastructure means what everybody thinks it means, which is bridges, roads, water management, plants, and these kinds of things. But also extending that definition, I would say, especially for our region, LNG, regasification, and LNG transporting through the region as well. And I would even say technology infrastructure. And by that I mean, bringing, if you look at pictures of certain Latin American cities, you see a lot of cables up in the air. So, bringing those cables from the sky to the ground. Those are things that happen. They take time, they take a lot of labor, and they generate jobs. So, that infrastructure technology is also a great, one of these two catalysts that I see in the region. So let me switch, and I believe I have a couple of more minutes. The other comment that I wanted to make, just talk a little bit about how we dealt with the crisis. And again, I think we're still going through the crisis. This is not over, folks. I mean, this is still going on. Who we are a 1.4 roughly $1 billion diversified sovereign wealth fund. We are structured in the way that is basically mandated by the Santiago principles. Plain coincidence that's called Santiago as well. And we have a board of directors, we have an executive management team, and on top of the fund and on top of the board of directors, there's something called an a supervisory commission made up of the civil society. So it is a very interesting structure, and that's why I say that we're only the true. When I say true, I mean the definition of sovereign wealth fund in the region. So there were essentially three pillars. I'm going to call them pillars of success, and I'm going to put success under quotes because we're still going through it as to how we dealt with the with the pandemic and its effects. At the end of the story, we contributed around $105 million to the government for different reasons. One was for economic development to sort of generate low-income housing. This is probably something that should happen towards the end, towards the beginning of the recovery period. And then the other reason why for the $105 million was really on the medical front, and Panama is one of the signatories of the COVAX vaccine alliance and program to sort of to make sure that Panama gets distributed. So that was used for that. So these are two noble and correct purposes. We don't, as the fund, determine how that use is to be done. We just make sure that that we invest properly long term and that the money's there when it's needed. So back to the three pillars, I would say one of it was governance. The second one was a strategic asset allocation focus. And I would say the third one is management. So let me go through them really quickly. On the governance side, I'm fortunate to report to, and I think the country's fortunate to have a board of directors for the fund that is a private sector board of directors. And what that means is that they have their day jobs, and their day jobs is not in the government. Their day job is managing banks and companies and these kinds of things. So we have very experienced folks to do that. And so we remain very engaged through this whole process at the beginning. A lot of Zoom calls. One of the negative, one of the positive things about Zoom is that you're able to do it from anywhere at any time. And one of the bad things is that you're able to do it from anywhere at any time as well. So we remain very engaged. We work with the government very closely in terms of what the fund could do based on the rules that were available. And I would say that engagement that allowed us to be very clear with us and with the government what the rules were for withdrawal, and clearly the government responded and executed along those same lines. And so that allowed us to sort of stand our ground. And I don't mean that in a defined or self-important way. It just meant that the rules are the rules, and we're ready to help. And we have to make sure that we follow them in order to help and assist the administration. The second point, strategic asset allocation. I think the most interesting thing about the strategic asset allocation and the focus that we had on strategic asset allocation during this time at the beginning of the pandemic was, number one, we had again clear rules. They were very clear. We have a diversified portfolio, but there was also this conversation about liquidity and what liquidity meant for us and what it meant for us during these particular times. And that was interesting because I think if you know, when I polled the board, the understanding of liquidity was very different. You know, was it cash or was it, you know, risk assets that you're able to sell right away without any impact on its price? And so we had to really get our minds as to what that meant, because that drove a lot of the discipline that we had to display in our asset allocation. We just didn't go and liquidate everything and put everything into cash. We stayed our course, and that allowed us to manage the expectations that the government had for us and also help out. And I would say the last point, the last pillar would be management. And that basically means, you know, it was a scary moment for our staff, for everybody. And, you know, constant communication. I mean, I Zoomed the hell out of them because it was a right thing to do. And they needed to know that, you know, even though working from home, it was a new thing, it was the thing that was going to guarantee that we were able to execute when the time came to do so. So, you know, again, big thanks to my team for staying the course and working, being so flexible in that regard. So to wrap it up, we again are by no means out of the woods. I think, you know, we had clear rules. We're fortunate to have clear rules, a clear mandate that gave us the confidence to sort of stay the course. Prior to COVID, we were engaged in executing on a private equity strategy, and the private equity strategy was basically stopped on its track as soon as the COVID situation came in. But as we developed the confidence, increased the communication with the government, I have to be honest, I mean, the market did help a little bit in its recovery, and that's something that we just don't have any control for, because we do invest for the long term. But that did allowed us some breathing room. And so now that things are over, we just recently announced, I would say a week and a half ago or so, our execution into the private equity space, which we hope on a long-term basis and in align with our strategic asset allocation should marginally increase our expected return while maintaining, or even at some point reducing our expected risk. So that is really all that I have to say. Not sure if you guys have any questions. Apparently there is a question. Questions. Okay, so yeah, so I have a question here, essentially asking about investment in the home market and versus overseas, and what does that mean for asset allocation? That is a question that I'm reading here. Hopefully, I'm reading it correctly. But that's a very good question, because even though, on the one hand, I think sovereign wealth funds could be used to invest internally in the country and help promote economic growth, you know, there's also this issue of going back to liquidity, and it depends on the mandate of the fund. In this particular case, you know, we can walk and chew gum at the same time, so I'm going to say that probably wouldn't have worked. But had we invested a sizable amount or all of the entire fund in the country, inside the country, it would have been very, very difficult for us to get the liquidity necessary to provide the funds that the government needed. again, it's all about mandates. It's all about the structure of the organization, and I think it's all about the long-term horizon. So both things can happen: investing internally and investing outside. But in this particular case, probably would have been challenging because of the liquidity situation, and that's one of the smart things about our law that created the fund. I wish I could take credit for that. I can't. It predates me, but it basically said you had to invest. Your asset allocation had to be outside of the country, and in our case, is mainly U.S. developed markets. Markets with a lot of depth, and so liquidity is good. And had we invested in, say, the local markets, the liquidity situation would have been very challenging, because at the very time that you need the money, the economy was malfunctioning. So hopefully that answers the question. I think I answered all the questions, because there are no more questions. So I'll hand it over to the organizers.
Thank you, Mr. Santiago. At this time, we'll pause in our program for a brief break. The program will resume at 11:10 a.m.
Okay, now you're unmuted. You're in, but we can't hear anything. Just coming back.
Welcome back from the break, everyone. I'm Robert. I'm the conference coordinator, and I'm honored to be introducing our next keynote speaker. He's the founding president of the National Council on U.S.-Arab Relations, Dr. John Duke Anthony.
Can you hear me?
Yes, we can hear you.
Okay, thank you. Still hear me till now, right?
Yes.
All right, here we go. Yes, ladies and gentlemen, it's a pleasure, a privilege, and an honor for me to be invited to participate in yet another annual conference on sovereign wealth funds. The visionary for them being Ghiath Naqshbandi and his colleagues, acquaintances, associates, and even some of his graduate students at American University. It should be obvious at the outset that one, I'm not a financier. Two, I'm not into investments. Three, I've not taken a single course in business administration. And for all of those reasons, I'm not on the same page or wavelength as most of the participants in this conference. What I can bring to the proceedings, if anything at all, will be a set of perceptions rooted and grounded and anchored in a degree of empathy, hammered out on the anvil of antiquity in the Arab region, the 22 Arab countries, 28 Middle Eastern countries, and 57 Islamic majority countries over a 57-year period. It's like being in a university from which there's no possible graduation, only on the best of days and incomplete. Now, in terms of my observations here, the following is offered, and because they may have fallen between the cracks in others' researchers' writings and readings and listening to speakers thus far. And one of these is that Arabs, first and foremost, have not forgotten, they're not unaware, they're not unappreciative of the fact that their sovereign wealth funds were not indigenously generated alone, at least, so much as they were generated, made possible by the technological and scientific and economic prowess of their Western partners. First and foremost, the British in Arab North Africa, the French in Libya and Somalia to a degree by the Italians, and the United States having picked up the baton over the last 40-some years. So there is a degree of usness, there is a degree of connectivity, there is a degree of linkedness between our two peoples' economies and trade, investment, and technology transfer, where the benefits are mutual and there's a reciprocity of rewards here. Now, the other way around, though, is not the same. There's an asymmetry here. Americans in particular, Westerners in general, have yet to arrive at a level of comfort and trust with regard to the uses to which Arab sovereign wealth funds might be put in their economies, whether as deposits or investors in equity or in infrastructure or in real estate, bank holdings, treasury bills and bonds and other kinds of debt instruments. This has been going on now since at least since the October 73 Arab-Israeli war. And so here we are at the half-century mark of a lack of trust on the Western side, and particularly the American side. Less so, but somewhat so, on the Arab region side. And this is despite the fact that Arab sovereign wealth funds are amongst the top 10, at least there are 4 of the top 10, and they represent 40% of the assets under control by these total sovereign wealth funds. What are some of the trends and indications that might not be so apparent to economists, financiers, and investments, as well as hedge fund and other investment managers? I would submit that they include the following. One, there's more and more a sense and a reality of independence by the Arab players, participants in the sovereign wealth funds based on the wealth from their countries. And this has enabled them to be more the formulators and practitioners and decision makers with regard more and more to their policies, to their positions, to their actions, and to their attitudes vis-a-vis the uses to which their sovereign wealth funds might or should or could be put. These are not identical to the perceptions, needs, and concerns and interest and investment goals of Westerners across the board, nor of Americans across the board. Now, one can ask, why is this? One has to do with a Shakespearean quote of "Hell hath no fury like a woman scorned." Arabs have yet to feel comfortable as though they're respected, that they are identified as equal partners or participants and players on the same field as the existing international and national economic institutions amongst which they have become players. Indeed, they have moved from the periphery of 50 years ago to being part of the center now. They're nowhere near overtaking, or posing a genuine threat to the pre-existing sources of wealth on the planet. But the fact that they've come into the tent, under the tent, and have been recognized as increasingly important players has been a matter of some concern to those who still see Arabs differently than as partners. So this is partly the why. And additionally, there is the question of education and the greater degree over time of the maturation and sophistication of Arab managers and participants and policymakers and decision makers in their sovereign wealth funds. Now, how have they been going about this? Some of the following statistics you may believe are typographical errors. How many, for example, in this conference know that there are a minimum of 500,000 Arab graduates of American universities in the 6 GCC countries of Bahrain, Kuwait, Oman, Qatar, Saudi Arabia, and the United Arab Emirates? 500,000, 300,000 alone in Saudi Arabia, and 200,000 in the other 5 Arab GCC countries. Now, how many know that the number of Americans who have received their undergraduate education from any of the several dozen now universities in just the Arab GCC countries, let alone those in Arab North Africa, the Nile Valley Basin, and the Fertile Crescent and the Levant? Rounding that number off to the nearest even number, the total is 0. Now ponder the implications of that for understanding, for rationality, for justification, on the basis of which decisions are made and policies are formulated. And a greater asymmetry in understanding and knowledge would be hard to imagine. And something else that the Arab side has done to circumvent the distrust by Americans of Arabs in general across the board, and Arab funds in particular, is that they have turned some things upside down and inside out. There are 2,968 American universities, and up until 10 years ago, the total number of US universities that had year-long courses on Arabia and the Gulf were 1. Okay. Now they're around a dozen, but out of 2,968, this is but a pittance. And all the more remarkable, given that this is the one region on the planet that the United States has mobilized and deployed more forces, killed more people, made more refugees, harmed more people, made more people orphans, made more people widows, made more people domestically displaced in their own countries than anywhere else on the planet. And so this is prima facie evidence of how important this region is to the United States, indeed to the world and to the global economies, and that Americans and others have been willing to shed their lives and blood to help render this area more secure. And without the security, there cannot be the stability. And without the stability and the security combined, there cannot be the peace. It was not the security, the stability, and the peace, let alone dreams and fantasies. The prospects for prosperity are minimal, are marginal at the periphery. And these are human-made mistakes. These are not natural mistakes per se. With regard to how this is proceeding, there is still the situation half a century later that the bulk of Americans, I don't have the statistical evidence, I don't think anyone does, but there's anecdotal evidence that the bulk of Americans still see these countries as oil wells and gas stations, not as countries. The bulk continue to see this region as mountains of money, rather than its peoples being the heirs to one of the richest cultures and civilizations ever to have originated and evolved on the planet. A culture and a civilization that has immensely and immeasurably enriched our own culture and Western civilization across the board. Thirdly, there is the persistence of the view that these countries, because perhaps they're so little understood and less well known, are perceived mainly as objects to be influenced, to be controlled, to obtain their funds from, to get investments from them, to get bank deposits from them, to have them continue to be wedded to the American dollar through thick and narrow, rain and fog and sunshine and night and day. This, despite the fact that they come out sometimes on the losing end, but because they do this, we remain far stronger than we otherwise would be. Indeed, this has been key to the ongoing preeminence of the American banking system worldwide. Fourthly, is the aspect of not looking at these countries in terms also, not just as objects, but as actors with their own legitimate needs, their own legitimate concerns, their own legitimate rights, their own legitimate interests, their own legitimate foreign policy goals, many of which are similar, if not identical, to those in the West and the United States, but many also are different. And they're different for reasons grounded in culture and societal dynamics and governmental relations and foreign affairs, as well as history. If there's time in the Q&A, we can go into this, but the divisions are profound. And let me disabuse anyone and everyone of the notion that these countries are not going to become carbon copies of the West or the United States. As Rudyard Kipling wrote, East is East, West and West, as ne'er the twain shall meet. In my view, they will not meet. However, they will become increasingly close. The interests will be similar. They'll be interchangeable. They'll be overlappable. They will be manageable. They will be mutually beneficial, and they will be reciprocally rewarding. Now, in terms of how to go forward from this, we still have the situation where since 9/11, Arabs and Muslims have been singled out for distrust and defamation and dehumanizing. All one has to do is read verbatim prevailing American legislation in this regard. It's unmistakable that the peoples being targeted are Arabs and Muslims across the board. In terms of the 9/11 Commission, the questions asked were not why, which is the all-important question, but how. And until we come to grips with the answer to the question on why, we'll be quite some distance from where we need to arrive. To bring these remarks to a close, there is a vast and growing body of literature about what the sovereign wealth funds have done that we in the West have either not done because we don't have the funds, we don't have the budgetary wherewithal, or the domestic politics do not allow it, or we have seen fit to allow the Arab sovereign wealth funds to proceed. A lot has to do with infrastructure investments, private equity investments, real estate investments, and increasingly a geopolitical, geostrategic role in the Northwest Indian Ocean, the southern parts of Arabia, and the Red Sea. That were these sovereign wealth funds not to be engaged, certainly the Chinese mainland would take that place in a millisecond. And we're unable to do so for domestic reasons and pandemic reasons and lowered economic resources on the whole. So thank you for your involving me here and allowing me to be a participant and a student and a learner in this august set of proceedings. Thank you, Dr. Naqshbandi.
Well, thank you. All right. Well, with that, I think we'll move the conference forward. Thank you for those insights. I think we'll wrap up at the end. And I think this is one of the beauties of this conference, bringing so many different disparate views and looking at this angle of the political, the geopolitical, the economic, the financial, the investments, the multitude of different dimensions that sovereign wealth funds bring to bear on the world. We're going to move on, I think, to the next speaker we have, Mr. Charles Cohen from the International Monetary Fund, of course, who's engaged all over the world in a number of financial exercises. Mr. Cohen is the Deputy Division Director of the Debt Capital Markets in the Division of Monetary and Capital Markets at the IMF. Mr. Cohen, the floor is yours.
Thank you very much. And I'd like to thank you for the opportunity to speak at this important conference. And I'm going to try to share some insights culled from some of the work the IMF is doing on financial markets more broadly. So let me just see if I can share my screen here. Okay. So for this talk, I want to think about two different issues. The first is sort of broadly, what are the financial and fiscal implications of the COVID-19 crisis, and what might that mean for sovereign wealth funds? And then on the second part, I'll talk about some of the best practices and policy for those funds given the crisis situation. So in terms of the financial implications, I mean, the first thing that I think everyone is well aware of here is that the COVID-19 shock is a tremendous shock to the global economy, much more severe and widespread than was the global financial crisis. So many of the charts here come from the newly released October Global Financial Stability Report and the World Economic Outlook, two of the IMF's flagship publications. The first on financial stability issues, which is the concern of our department, the Monetary and Capital Markets Department, and the second put out by the Research Department, thinking more about global growth trends. So what you'll see here is that on the 20, which corresponds to this year, you see a tremendous growth in countries that have actually seen very negative rates of growth, really an unprecedented development in the modern economy. But projections are that we should see quite a sharp recovery from this. However, that is, of course, still to be seen. Now, what are the implications of this massive disruption for sovereign wealth funds? Well, what we see here is some selected data on the broad investment portfolios of different sovereign wealth funds and pension funds around the world. This is a very complicated chart that you're not supposed to absorb, but just notice here that you'll see a large variety of funds with investments concentrated in the yellow portion, which is fixed income and cash, another large portion in equities, and another in alternative investments. You might think of these as roughly corresponding to the risk appetite of the different funds. And the important thing here is that the future return profile of all of these asset classes has been dramatically impacted by the COVID crisis. And I'll try and talk a little bit about what we can see in that regards based on recent market developments. So first of all, in fixed income policy, the thing that has really been supporting markets since the crash has not been a change in fundamentals, but has been a change in policy support. In particular, a change in what are viewed as both current and the potential for long-term risk-free rates dropping dramatically. So what you see here on the chart on the right is the black line represents the yield of US investment-grade corporate bonds, which you can see spiked dramatically in March and now has dropped since then to levels even below what they were pre-crisis. And why is this? Well, above the line, we see fundamentals have actually gotten worse and should be raising yields. But below the line, we see, as I mentioned, with risk-free rates dropping and other forms of policy support, including the outright purchase of bonds, compressing yields, they've dropped dramatically. So what does this mean? Well, for sovereign wealth funds and many other investors that are looking to match long-term liabilities with long-term assets, this fixed income market presents a challenging investment environment. Of course, this has been true for a long time since the global financial crisis, but now these issues are even more accentuated, particularly given risky fundamentals. Now, what have we seen in equity markets, another major source of investment for sovereign wealth funds? Again, globally, there's quite a differentiation. In some markets, we've seen a strong rebound based on strong policy support. For example, in the US, China as well has seen a strong rebound, though perhaps fundamentals are better there. And so in other countries where either fundamentals have remained poor or they haven't had the room for policy support, we haven't seen much of a recovery in equity markets, though of course all of them are well off the troughs of March of this year. And so what we see here on the next slide, this is a similar decomposition to what we saw previously. The black line here represents equity returns in the US for this year. As we see now, we actually are up to positive year-to-date returns. And what has driven this? Well, in March, they were tremendously negative, driven by the growth of the gray bar here, which was equity risk premiums, essentially a tremendously negative view on the future despite earnings. And then since then, what has happened? Well, the risk premium has actually reversed since then. Why is that? Again, as I said before, there's been tremendous liquidity support, but the risk-free rate, again, low interest rates, given the long duration of equities, has really lifted the market there. But note on the downside that current and projected earnings continue to decline. That's the light blue line here. So now we're in a situation where we are back to the very high levels of valuation that we saw at the beginning of the year, but this is under a weaker and a more uncertain earnings outlook, given some of the fundamental issues around COVID that still persist. So again, you think, what is a sovereign wealth fund manager or anyone really investing for the long term to do in such a situation? Another area which is of particular concern to many sovereign, to many countries with significant sovereign wealth funds, as you're well aware, is energy prices. What we see here is commodity prices looking over since about 2014. The three different graphs here. The blue is for petroleum spot prices, which, as we're all aware, collapsed in March of this year, have rebounded sharply, but still remain well below previous levels. Whereas other commodities, such as food, which saw a sell-off, have rebounded. Metals have rebounded even more strongly. Of course, much of this represents some of the fundamental shocks that COVID has placed on our lives in terms of the inability to travel and other things that might reduce the spot price of petroleum. I think the question of where this goes from here, of course, depends on the fundamental recovery. But it's important to realize that these persistently low energy prices may have very important implications for many sovereign wealth funds and how they think about their future asset allocation. I mentioned before, there's been an incredible amount of policy support that has lifted financial markets. On the other hand, mostly coming from central banks. On the other hand, there's been incredible fiscal support, really an unprecedented amount of fiscal countermeasures that have already been deployed. So what you see here, and this is from our World Economic Outlook, newly revised, is on the left-hand side, we see in advanced economies, a tremendous change in the structural fiscal balance in 2020, and even something similar, given their ability to deploy funds, happened in emerging markets and developing economies. Now, the expectation for 2021, at least in advanced economies, is for this to reverse. That may or may not happen. In fact, we think this extension of these fiscal countermeasures represents an upside risk to global growth. But at the same time, debt is debt, and these levels continue to rise precipitously, and that may have very serious implications for the ability of countries to spend in the future. And as we see here, sovereign debt is now at historically high levels. So these constitute the systemically important countries as defined by the IMF. You'll notice that nearly all of them are at the very top of their sovereign debt to GDP ratios over the last 30 years. Of course, in the current environment, this doesn't mean debt is not sustainable. Lower interest rates may offset the higher debt levels we're seeing and the potential for lower growth rates into the medium term. However, that still means that sovereign debt vulnerabilities are high and something that governments need to contend with as they think about their budgets. So bringing all these issues together, what does this mean for the challenges for sovereign wealth funds, both during and after COVID-19? The first, I think, as those charts makes clear, is that these very traditional sources of returns may be hard to come by. Sovereign wealth funds will likely be tempted to continue their expansion into alternative assets. That's something which has been going on for a while. Again, reach for yield is not a new phenomenon, but in terms of the extent of it, we're really seeing a step change versus what we saw even after the global financial crisis. This may, of course, be a profitable expansion, but it also comes with significant risks. So in general, it's very likely we'll continue to see this movement by sovereign wealth funds. Now, of course, with this movement into alternative assets, that also intersects with another potential need, which is that local institutions may need capital. What we've seen so far this year is, a tremendous outflow from emerging markets, and then a reversal of that outflow, of course, with some differentiation across countries. And we still may need capital for local institutions. So this may result in a potential for heightened pressure, potentially political pressure, for sovereign wealth funds to invest in their domestic market. And that may even include support for challenged or even insolvent institutions. You could think about systemically important banks or SOEs or others that may be in need of funding, and sovereigns may think about this ready source of capital in sovereign wealth funds as a way to plug those holes. In addition, there's the point about strong fiscal pressures. There may not be that much fiscal room given how much debt has increased. And so that means that decisions have to be made about short-term budget support versus investing against long-term liabilities. So all of this is really sort of an unprecedented shock for sovereign wealth funds and potentially a need to change their course rapidly. And the thing I want to talk about in the last section here is just how important a strong institutional framework for sovereign wealth funds is in such a situation to make sure that they're making decisions properly. So here I want to give a little more detail on some policy prescriptions here that I think we think are broadly best practices in this area. The first thing is that whatever sovereign wealth funds do in terms of asset allocation, they need to remain true to a broader medium-term fiscal policy objectives and to asset liability management practices. So first of all, if in the present crisis governments are running large deficits, sovereign wealth fund assets could be used to fund the budget, but this has to be done as part of this medium-term fiscal strategy that ensures both fiscal and debt sustainability. More generally, objectives and management of the fund should be well aligned with the overall fiscal policy objectives. So this depends on what the fund was set up for. If the main concern is to ensure enough stabilization savings to manage volatility in resource revenue and protect the budget, the strategy should be geared toward liquid assets that are easily available if needed. So again, as I mentioned, if we're thinking about alternative assets, an illiquidity premium, that's not necessarily compatible with a stabilization objective. And in addition, the assets and liabilities of the sovereign wealth fund should be included in the overall government's asset and liability position to allow for better management of the public sector balance sheet. So for example, they should avoid borrowing expensively if they have assets that have lower returns, and in general to think about the sovereign wealth fund as integrated into debt management. Secondly, if the fund feels the need to take urgent COVID-19 related action, the transparency is essential. If governments want to use the funds to tackle the crisis, spending should be done through the government's budgeting process. And any spending the Sovereign Wealth Fund does should be subject to the same scrutiny and accountability as any other government spending and included in budget documents. If, as I mentioned before, the Sovereign Wealth Fund is involved in granting loans or guarantees during the pandemic, it is important to create safeguards to avoid political interference and ensure effective monitoring and transparency of these activities. So action should be costed, including potential fiscal risks, and approved by government, just as you would think about for any government backstopping or anything where the process is not purely on an investment basis. Anything with an expected cost should be approved through the budget process or at a minimum be included in budget documents. And this will require special caution if current sovereign wealth fund governance is weak. You need to have mechanisms to ensure a high degree of scrutiny, and decisions have to be in line with public policy objectives done transparently and at arm's length. Lastly, I should mention that even given the crisis, and even given what might be urgent needs, this still represents a good opportunity to act on any needed long-standing reforms to improve the overall management of sovereign wealth funds. Though there's been a tremendous progress in this area, many sovereign wealth funds still lack key elements of good governance and transparency. This has the potential to undermine the management of the large financial assets they hold, and reforms can both help ensure the assets are better managed and even potentially lead to higher returns. The operations of the fund should be transparent, and there should be a strong governance structure. Transparency requirements should include, of course, disclosure, but regular and frequent reporting on the principles governing the fund, inflows and outflows, investment policy, and how assets are allocated and their returns. Finally, sovereign wealth funds should strive to fully converge to the aforementioned Santiago principles. We think this is a very important statement of best practices that should be followed going forward. So in conclusion, I would say that given the macro events, this is really a time of great challenge and great uncertainty for sovereign funds. And in such an environment, it's very important that what we've learned about institutional frameworks and how important they are for maintaining stability and avoiding any negative outcomes is crucial. Thank you very much.
Thank you. At this time, we'll have a video from our Professor Spence.
Good morning, ladies and gentlemen. It gives me a distinct pleasure to have a chance to have an interview with Professor Michael Spence. Michael Spence doesn't need introduction, but I'd just like to highlight a couple of important things for us to be aware of, and his CV is available on the website. Professor Spence is the Philip Knight Professor Emeritus at Stanford Graduate School of Business. And by the way, he was the Dean of the school for many years, in addition to his deanship at Harvard College of Arts and Sciences. In the meantime, Professor Spence is a distinguished fellow at the Council on Foreign Relations, and he is an honorary fellow of Magdalen College at Oxford. And in addition to that, he teaches at Bocconi University, one of my favorites in Europe. As we all know, he won the Nobel Prize in Information Economics back in 2001, one of the foremost scholars. So it is an honor and privilege to have Professor Spence. Professor Spence, I would like to start by asking you, as a general question, when do you think the specialized agencies will be in a position to assess the impact of COVID-19 on the world economy?
Well, it's a very interesting question. So, I mean, the way I think about it, and I don't think I'm alone in this, is that it's a continuous process. So there's some things we already know about the impact of the pandemic economy. One, there's been and we could spend all of our time together on this. There's been a huge acceleration in various aspects of digital technology and its adoption in the economy, and that's pretty much across the board. And while some of that has been done under emergency circumstances because of the mobility restrictions that the pandemic economy has required, almost everybody thinks that, you know, a subset of that accelerated adoption will actually stick. And the reason for that is, of course, that people have learned things that they didn't know before, and there's a clear bias in the direction of too little experimentation under normal circumstances, both by people and organizations. So I think, you know, we've discovered possibilities. Some of them have turned out to be very valuable. That's a clear winner, and it's reflected in the markets. Now, you know, they may be slightly over enthusiastic about this, but there's all kinds of evidence that digital technology is going to be an important feature, an increasingly important feature of sort of economic life, of resilience, of healthcare and education, and a whole lot of other things. So that's one. The second one is, you know, we've learned how the economy works in the pandemic. So you get an enormous contraction. It varies from country to country. Then you get a trough where essentially relatively little that's non-essential happens. And then you get the start of what looks like a fairly rapid recovery, and then it slows down. And it slows down because there are sectors that are very hard to bring back until you get rid of the virus or reduce it to a level where it doesn't pose a risk to people in their own minds. And those sectors are pretty clear. I mean, hospitality, air travel, you know, there are others. But so those ones are the ones that have been hit in the markets. They're the ones that are struggling to come back. Do you look at the underneath a typical, you know, stock index like the S&P 500, you find companies that are up 25%. They tend to be digital and or ones that, you know, generate value through intangible capital, and then you get all the way down to airlines, which were down 60% at some point, and they're now down 40%. So that we can see. The harder stuff to see is sort of what's going to happen to the global economy. Will this increase the sort of trend to fragmentation that we've seen? You know, is it a wake-up call and we'll return to sort of some level of cooperation that we didn't see before? Those things are very hard to make precise, even guesses at this point.
Thank you very much. If I may switch to another topic, another area, for a long-time investors, like most of the sovereign wealth funds, institutions, is it more efficient to maintain the existing investment portfolio guidelines or to change the guidelines as current conditions and market forces change?
Well, that's another very interesting question. So it's certainly possible to overreact to short-term contractions, shocks, and headwinds. And so there is something to be said for being cautious about, you know, changing parameters, changing asset allocations, and going overboard in reacting. to this. Having said that, I do think that there are a number of reasons why a good rethink of the fundamental sort of parameters of a portfolio is an important step to take for major long-term investors. So let me give an example. So one of the things that's happened in the pandemic economy is that balance sheets took a shock all over the place. Some of those balance sheets were big enough to withstand the pandemic. Think of small businesses or households that didn't have much in the way of net assets before. So what's been going on in the countries that had fiscal space is they've been basically transferring that balance sheet damage to the sovereign. And so we've had a big run up in debt in the sovereign. And central banks, for the most part, although they played a role in attempting to buffer the shock, have basically been standing behind the fiscal programs that were designed to prevent, but to both buffer the shock and prevent long-term damage that would impair future growth and the recovery from the pandemic economy. And so they, to the extent that they were on some very, very gradual path of sort of normalization or whatever you call it with respect to interest rates, exiting from aggressively accommodative monetary policy, the major central banks have reversed that for the most part. It varies from place to place, but certainly in America and Europe, they've not only reversed them, but it looks like with the levels of debt we're going to come out of this with, whatever they are, it's not going to be easy to go back and resume the monetary policy course we were on. And I think the central banks are issuing statements and so on that make it clear that they kind of understand this. So the bottom line is, at the risk of skipping over some subtleties, is we're in for a fairly extended period of fairly accommodative monetary policy with very low interest rates. And that has significant impacts on other asset prices, on investment portfolios, and so on. So, and there's probably a whole lot more one could sort of try to get at when one starts digging around. But I think that's certainly one. And another one that's occurred to me, and I haven't heard it talked about much in the press or the investment community, which is that the pandemic economy has produced an unusual level of divergence in the performance of assets in various sectors, especially the publicly traded ones where it's easy to see. At some point when we recover, that divergence is going to start to decline again. And so things that look like they're in great difficulty now may turn out on a kind of short to medium time horizon to have a period of sort of outsized performance. Now that's tricky to take advantage of because you've got to get the timing right and not be wrong about whether they're going to actually recover. I mean, so, but nevertheless, I think, this is a sufficiently large shock with potentially long-term structural implications that smart investors, smart long-term investors, especially the sovereign wealth funds, will probably want to, take a serious look at what it means in the long term for their investment strategies.
Thank you. I cannot miss the opportunity today to ask you a burning question that I had for years, actually. You are in a very unique position. You are a prominent scholar. You are a prominent academic administrator. You manage departments, you manage schools. And in addition to that, you had a wonderful and extensive experience in the private sector. So my question to you, if I may, as the world prominent scholar and educator, why do you think business schools do not emphasize sovereign wealth funds more significantly? And I'm asking this because I have a hard time in promoting the discussion about sovereign wealth funds. And one of the criticism that I hear from some of my colleagues that there is no data. Well, I understand that. But in addition to that, I'd like to hear your view, and our guests at the 7th Sovereign Wealth Fund Conference 2020 at Kogod School of Business would love to hear your thought about it. Please.
Another excellent question. I mean, let me just start out by saying what I guess is the conclusion, which I think, relative to its importance in the world. I mean, these are very large pools of assets that have a significant impacts on investment programs around the world, on infrastructure investment and so on. I don't have any question that the level of attention devoted to them in academic research is below optimal, for sure. Having said that, I guess the obvious question is why is that true? I think I don't really know the answer to that. Academic communities set their own agenda, and they tend to sort of get not sidetracked so much as focused on specific things. So a lot of financial market research in finance has had to do with how the markets react, how they set prices, momentum trading, things like if you have a lot of automated trading going on, what are the implications sort of for market dynamics? Questions like that. And they probably leave some things out. If one wants an example from both economics and finance, I mean, one of the reasons when we were coming into the financial crisis that a very small number of people saw it coming is the vast majority of us were operating with models that came out of previous research on the economic and macroeconomic side, in which finance played a far less significant role in the models than it in fact does in real life. So that was a kind of what I guess I would call that a huge blind spot. And it's probably not the only one. There was a few years ago discussions around the question of the status of sovereign wealth funds in the kind of global financial system. And there was quite a bit of writing on it. And the gist of that writing is that sovereign wealth funds, which are basically public institutions, have done well and been not only accepted, but admired in many cases because they are and behave like very sophisticated investors interested in long-term returns, as opposed to something else that vaguely resembles, an arm of their state. So that conversation did go on, and sovereign wealth funds for a period of time got a great deal of attention, but in that context. I think data is you mentioned it at the start, guys. I think it's actually one of the reasons research is driven in part by the availability of data. I'm not saying there's no data available, but sovereign wealth funds have been, as far as I understand, a little careful and selective about the level of detail in their investment decisions and portfolios that they've been willing to disclose. It's probably changing over time, and it's probably more transparent now than it was, say, 20 years ago. But the bottom line is, I mean, I think these are huge pools of assets that deserve more attention.
That's really great, and I'm going to carry your recommendation and your assessment to facilitate my mission in spreading this wonderful area of investigation and interest in the finance world. Professor Spence, it is great privilege and an honor to have you as a keynote speaker at the Sovereign Wealth Fund Conference at American University, Kogod School of Business. And I really wish that we will have the chance to host you next year. Usually we select the date and the time in October. And as you know, the IMF is going to hold their meetings next year in Marrakesh, in Morocco. So we will have more freedom in selecting the date. Once again, thank you for joining us, and I appreciate the opportunity. Thank you so much.
Thank you, guys.
I hope everyone enjoyed the keynote remarks of today's conference. We'll now be moving on to the panel debate part of the conference. The first panel, Panel A, is going to look at the assessment of recent changes. The panel is going to last 30 minutes, and it'll be followed by 15 minutes of Q&A. So during that time, please, I invite you to ask any questions you have for either the moderator or the panelists in the Q&A section on Zoom. Today's panel will be moderated by the Managing Director of Global Sovereign Wealth Fund, Mr. Diego Lopez.
Thank you, Robert. I think I'm having some trouble with switching on the video. I don't know if it's about permissions.
Could you try again now? I think we fixed it. Great.
Great. Well, good afternoon to you all, and thank you very much to Professor Naqshbandi, to the American University, and to Kogod School of Business for putting this event together once again, even if virtually this year. I certainly look forward to going back to Washington, D.C. for the 8th version of the conference next year. I have been kindly invited to chair the discussion on the recent changes and trends that we're seeing in the sovereign wealth fund industry, which to our account in Global Sovereign Wealth Fund stands for over $9 trillion assets under management. Now, COVID-19 has represented and represents a huge test for the financial markets, and that is especially true for sovereign wealth funds, which are also affected by the situation in their domestic economies. In the first 3 quarters of 2020, sovereign wealth funds deployed less than $53 billions in private markets around the world. This is a 50% decline over the same figure in the first 3 quarters of 2019, which was $105 billion. Other sets of global investors, such as public pension funds, have not been affected as much, only a 6% decline. And that is because sovereign wealth funds are subject to withdrawals and capital calls according to their mandate. So far, we have seen $138 billion in withdrawals in 25 different countries around the world, and that includes Panama, which we heard about before. And this figure will certainly increase by year-end when the Middle Eastern economies, which have been subject to the dual shock of oil prices but plus COVID, will formalize their capital calls. So what are we seeing in the market? And I'm keen to get my panelists' views on this and other topics. First of all, focus on resilience, not only as investors and in their portfolio, but also as organizations. Second is integration of the ESG factors into the investment decision process. Thirdly, we're seeing a lot of tilting in the strategic asset allocation of the funds. And fourth, as Mr. Santiago said before, the onshoring and further collaboration among sovereign wealth funds and other asset owners. So without further ado, I would like to give the floor to my panelists. First, I would like to ask you to briefly introduce yourself and give your views on what you're seeing in the sovereign wealth fund market this year. And then I will ask you more tailored questions according to your specific focus. So I will start with Mr. Altamimi, please.
Yes. Good afternoon. Do you hear me? Hello?
We can hear you well. You can speak. Thank you.
Okay. Well, I think, first of all, I would like to introduce myself. I am not a senior advisor for Kuwait investment project companies. I used to be a former advisor. I'm now a freelance consultant and an economic researcher. One thing which I would like to emphasize here, as far as the crisis we are undergoing now, I think the most important difficulties facing Gulf states, including Kuwait, is that lack of reforms. I think what they have to do now, facing difficulties in the oil market and decline of revenues, they have to reform the economic structure. They have also to revise fiscal policies, because they have not been able to to fix the situation with employment or subsidies for the last few decades. And now I think they have an opportunity. They are pressed to do the reforms. But because of the political situation in some of these states and the populist demand, the difficulties with reform is abundant. And so I believe that they have to do some good efforts. Do you hear me?
Yes.
Yeah, okay. So I think, we have been facing fiscal deficits the last few years, since 2014. And this year, the fiscal deficit in some Gulf states is tremendous. And I think they will have to borrow money in order to finance their deficits. And in places like Kuwait, for instance, they have difficulty convincing the parliament to allow the government to borrow from local or international banks. And there are pressure on the government to use revenues or to use assets like the sovereign wealth funds. But the law does not allow the government to tap those assets. And I think it is not really wise now to tap such assets at this time, because the markets are not great. And I believe that the best way is to restructure the economy, allow more involvement of the private sector, and rationalize the role of the state in the economy. And this will enhance the possibilities of fiscal reforms. Another thing is that, in a place like Kuwait also, as you know, that there is this sovereign wealth fund requires that the government allocate 10% of the state revenues to the fund. But recently the government decided to stop this and decided that once we have a deficit, we should not allocate 10% of our state revenues to the fund. But when we have a surplus, we will do that. And this is also a sort of amendment of the law. And I believe that, that there is there is a need for transparency because the public is not aware of how the fund is allocated, where the money are allocated, what sectors, what countries, what currencies. And there is a need for transparency, and the people should know. And once they know, they will be able to realize the possibilities of using some of those funds and financing the deficit for it. And if the people think that we have so much money and such money are easy to liquidate, then you have a difficulty, I mean, convincing them not to have the funds. But I believe that the funds are supposed to be used for the future generation and not to use them for current situations. For current situation, you have to depend on the usual revenues, and at the same time, if you cannot satisfy the fiscal needs, then you have to reform. And there is a need for reform and a need for transparency. And I think we will face difficulties in the coming years. There will be changes in the consumer behavior, which will be reflected in many sectors in different countries. And that will also be reflected on our economies, because our economies are exposed to the world economy, and we cannot say that we can depend on our local resources. We have to depend on the world and how the world economy behave, and how we can utilize our funds in the future. This is what I think. I think the governments are in need to face such problems and to be transparent with the people and to implement the needed reforms. Thank you.
Thank you, Mr. Al-Tamimi. That is fascinating. I think Kuwait is a really good case study, and I will have so many questions about KIA, but I'm conscious of time, so we will keep them for the last part of the panel, if you don't mind. So I will proceed with Mr. Davis. Please introduce yourself and state what you're seeing in the market these days.
Great, thank you very much. It's a pleasure to participate. I'm honored that I have been participating since the inception of this event, and it continues to grow in terms of interest and scope and perspectives. And earlier today, I think we had a wide variety of different views and perspectives, and it just shows how complicated the situation is. I'm a partner. I'm a partner at Squire Patton Boggs, located in Washington, D.C., but have had the good fortune to be part of the Middle East and part of the sovereign wealth fund industry since the late 90s, and have worked with a number of different sovereign wealth funds to try to assist them in various matters, including their relationships with banks and securities lending, and basically the protection of their portfolios to try to get way beyond market protections compared to what the banks initially offer. Also in the area of private equity in co-investments and some fund investments. So when we look at what's happening today, it's a dramatic shock. for some countries, it's a double shock because not only do you have the oil prices, but you also have the effect on tourism, hotels, airlines, hospitality industries, and day-to-day life. But, you know, Dubai is a good example where, you know, the government was diversifying, and it diversified into you know, shipping, into airlines, into hospitality, into real estate and other things. And this is a big hit. And, you know, it needs funds to stabilize. And, you know, the UAE will help Dubai, and Abu Dhabi will help Dubai, but these are things that call for liquidity and resources. So every sovereign wealth fund is different, meaning that some are extremely well capitalized and have excess assets or are being given assets to invest. And they've taken this as an opportunity to find bargains and to continue with their overall strategy. So in general, there's been a move towards technology and venture capitalism, and you know, sovereign wealth funds like PIF have, you know, bought into distressed industries. They've also bought into high-tech companies during the pandemic because they see favorable pricing and opportunity to be to buy low under stress. And certainly, if you're a long-term investor, that's a basic premise, which is you can use your capital to do so. However, another issue, cross-current, has arisen because of the needs for the governments for funds. And this varies tremendously per fund. But for example, in Oman, they've consolidated their sovereign wealth funds into a single entity, the Oman Investment Authority, but they're also facing fiscal challenges. So the issue becomes, how do you have the necessary liquidity without upsetting your long-term investment strategy? And as I think was mentioned earlier, money is cheap. I mean, there's never been a better time to borrow. You know, traditionally, the sovereign wealth funds have not had to be borrowers because they've been piggy banks for excess capital from the country, oil exports or other types of capital that has been available. But now the influx is not coming in general from the government into the sovereign wealth funds, it's going from the sovereign wealth funds into the government. So the first thing a sovereign wealth fund has to do is recalibrate under this emergency situation and coordinate with the government to see what the liquidity needs are in the upcoming, you know, months or years. Depending on how that works and what is anticipated, they need to go back and look at their investment strategy and then see whether it still matches up with their liquidity requirements. You know, pension funds are very good at this because they have all kinds of algorithms and data and statistics to determine when they have to pay. But sovereign wealth funds, it's been less clear because in some cases, the government always puts money in and doesn't take it out. Well, now they're starting to see it's being taken out. So how do you recalibrate? One way to do it is to rebalance your portfolio. There's been a general trend to move away from debt securities because of low yields as assets, to move towards private equity and to controllable investments like infrastructure and other things where there can be added value by the investor and they believe they know the markets. So that's been a trend, but those are illiquid investments. So it's kind of a cross current. Do you want to continue to put money tied up in funds that are tied up for 7 to 10 years, maybe longer? Or do you want to have immediately available cash? Another issue is public securities. When the US market fell 40+% in the March-April period, I think a lot of people looked at their balance sheet and said, oh my gosh, this could be really bad and it could be for a long time. What are we going to need to do? Now, the markets have recovered, at least in the US and in China and some other places, but not completely. But that's a warning shot. meaning that we could have further turbulence, and these black swan events, you know, when they happen, there's no guarantee there's only be one at a time. So everybody has to be much more wary and cautious. So I think the comment was made earlier that what do you do when money's cheap? You back up the truck and take the money. So I think what's going to happen is, just like corporate treasurers, sovereign wealth funds are going to now start to focus on using debt for their advantage. And that can be through borrowing at low rates and then reinvesting and making a profit, or developing credit facilities or other liquidity sources. So if there are short-term needs for capital, they don't have to liquidate their assets. And this is a new trend. As I say, in general, the problem has been I got too much money, not I have too little money, but now it's uncertain. So there are a number of ways that sovereign wealth funds and governments can borrow. I think that the relationship between the sovereign wealth fund and the government needs to be very close to coordinate their strategies. But if you have pools of assets, you can borrow against the assets, and in essence, securitize them and get loans with them as collateral. That can be done at a very low cost, oftentimes at a lower cost than the borrowing cost of the government, because the government's credit rating is based on its overall financial condition, not on particular pools of assets. So sovereign wealth funds can be very efficient sources for borrowing and for liquidity. You can enter into private loan transactions with banks, or syndicated loan transactions with groups of banks. You can have bond issues. You can have structured finance, which is what I was talking about, where you have collateral pools that are used for assets. And some sovereign wealth funds have already engaged in this in the past, so they have market history and relationships, so it's easier for them to do that. But this is a continuing trend. Saudi Arabia, I believe, borrowed had a $30 billion bond issuance. So I think other sovereign wealth funds, particularly the smaller ones, will also try to look at their balance sheet and try to see, how can I create liquidity, flexibility, and perhaps take advantage of opportunity in the markets? Because if you're a long-term investor, whenever you have this type of catastrophe in certain industries like hospitality, airlines, cruise ships, restaurants, etc., it will create great opportunity. And as Professor Spencer said, it will rebound. And when it does, there'll be profits made. So that was my initial statement. Thank you.
Excellent. Thank you very much, Geoff. There are some questions from the audience, but I will keep them for the end once we've given the opportunity for everybody to speak. Dr. Hingorani, I'm very glad that to see you again, to see you in my panel, because India seems to be the flavor of the year. There have been 26 transactions in India with 12.4 billion deployed so far in 2020, including NIIF, but also Reliance, different vehicles, Edelweiss, and the Tower Infrastructure Fund. So I'm very glad to have you here. Please introduce yourself to the audience and let us know what you're seeing in the market this year.
Yes, thank you for that. I have been actually, involved in alternative assets almost all my life. I started in this field in the early 90s in India. I continue to operate in that space, and have done investments in infrastructure, real estate, and a lot more. But in recent times, I've focused on, 5 years ago, I thought that the whole investment cycle was going to change for every sector. So technology may be a better space to be in. And that sort of borne fruit even in today's situation. So in relation to SWFs, I wanted to first say that I agree with Geoff. There are SWFs that are continuing on their strategy, and there are others who have been pulled into their domestic situations. But I think even prior to the pandemic, if you go back to Jan of 2020, there were already signs in the market that it was overheated. Many sovereigns as well as large investors were rethinking their investment strategies. So to that effect, I don't think it was that much of a shock to the ones that were already rethinking strategies about valuations being too high, we need to reallocate, etc. They probably got the right entry point today to be able to do what they're doing. For example, if you look at India, and you mentioned so many different transactions that have happened, in the infrastructure space, you've started to see a lot of capital flow in, albeit direct investments, not so much, funds, sovereigns or other people putting investments in funds who in turn put money into the asset. But in the infrastructure space, you're seeing a lot of investment come in from sovereigns and larger investors, largely realizing that, okay, in 2020 Jan, we thought that this was very, very expensive. The whole market was, India was also expensive. Here's our chance to come in at a relatively better entry point, and let's do this because we are here for the long haul. So you've seen that in, you've seen that in purchase of roads, in purchase of non-conventional energy assets, solar, etc. You've seen that in towers. A lot more has happened in the last, let's say, last 6 months. Similarly, if you go to the real estate side, I mean, for many of us, when you read the first few newspapers, let's say March, April, everybody was thinking about the real estate sector coming to a complete end. You do see a reversal of thought. People are now giving measured reviews, but in the Indian context, it's gone to the other end, where almost every REIT and direct large investors have started participating in real estate, because they again feel that this is the right time to come into a market that is sustainable over the long term, but has a good entry point. So that's one part, if you look at infrastructure and real estate. The other point I wanted to make, which I think Jeff already brought up, but something that I've been sort of living for the last 4 or 5 years, is pushing the concept of technology being all pervasive, and every sector needs to recalibrate and disrupt themselves, right? In that context, if you were to ask me in January of 2020, how easy was it to define or explain this to potential investors or to sovereigns, etc., the answer was they got it, but they didn't think they were in a hurry to get in there. Right? But if you look at the statistics today, I'm told by PitchBook has shown that SWFs by themselves have invested $17 billion up to June 2020 in ventures, because they now see the connectivity. Especially 3 or 4 sectors stand out completely. Education, everything has gone online. So you're seeing a lot of innovations there, a lot of direct investments by SWFs. Health tech, many people call it telemedicine, but it's gone way beyond that in terms of, technology's ability to provide the right kind of, medical advice or medical, protocols that are needed to define what a patient is going through. Or the third case in point, for smaller countries or for emerging markets, the agriculture and logistics space. Lot of technology going in there. So all told, there are, I think, dichotomies in the way SWFs or large funds are looking at the markets. There are also dichotomies, just like the Panamanian gentleman spoke. He did say that there are 2 kinds of worlds out there today. The ones that investment markets are used to, or let's say the people who are slightly better off are used to, where they're seeing things were down, but they're starting to recover, and you can look forward to seeing that things will get better. But that lower half of the world's economy, the poor sections of society in any country, I think will take a long while to come back. So those 2 discrepancies always will come into a SWF's decision-making process when they decide what they want to do. Those were a few of my opening remarks for this.
Thank you very much, Archana. Mr. Noel, I'm also very happy to have you in the panel. You have written extensively about strategic investment funds, which are also quite trendy, with 2 sovereign wealth funds established this year in Djibouti and Indonesia, and they are both SIFs, fundraising capital from other sovereign wealth funds. So please introduce yourself to the audience and speak a little bit about what you're seeing in the market.
Thank you very much, Diego and Professor Naqshbandi. So it's a great honor and pleasure to be joining the conference today. I am Michel Noël. I retired as head of investment funds at the World Bank in 2017. And now I am a co-founder and managing partner of Sovereign Fund Advisory, a small consulting firm. And I am a senior consultant for the World Bank in the investment fund area. And essentially, over the past few months, I have been involved in the preparation of several new strategic investment funds in various sub-regions where the World Bank is active, in Africa, in Southeastern Europe, and in East Asia. And each of these engagements involve funds that are at the preparation stage for financing by the World Bank, or in the case of Africa, by IDA. And there are a few tendencies that come out of these new funds, which I think are of interest for the participants. First of all, these funds are essentially green strategic investment funds, or in one case, a blue economy strategic investment fund. So they are thematic, and the theme has to do with the green economy, climate mitigation, climate adaptation, biodiversity, which means that the very essence of a strategic investment fund, which is that these funds are based on a double bottom line for the selection of projects, is at the core of the structuring of these operations. Essentially, to put it simply, the funds seek to maximize the economic rate of return, subject to a minimum internal rate of return, which basically acts as a threshold, as a threshold for entry by private investors. The second characteristics of these funds is that they are hybrid. These are not purely public funds, they are hybrid public-private. They seek, in general, a 50% public, 50% private investor base. Among the public, you find, of course, the government, international and bilateral financial institutions. And on the private side, you find institutional investors, both domestic and foreign. The third characteristic is that all of them are privately managed. So essentially, the typical structure is a structure of a limited partnership where the government is a sponsor and a co-general partner, and where a private fund manager is competitively recruited and becomes also a co-general partner. So it's a very well-known structure in the private equity industry. And the reason why this structure is generally chosen is because it is familiar, of course, for the institutional investors that are invited to participate in the funds alongside the public sector. And the fourth characteristic of all these funds, and it is an important link with some of the things that have been said before, is that they are regulated. So the fund itself is registered with the Capital Market Authority of the country. The private fund manager itself is registered and licensed by the Capital Market Authority. And those funds are subject to all the disclosures of investment funds in the country. So they are meant to be fully transparent in terms of their sources of funds, in terms of their investments. They are subject to the production of annual reports that are published, that are registered, of course, with the Capital Market Authority, that are published and made available to the public. And this is perhaps a very important dimension, because as Professor Naqshbandi has indicated earlier, one of the problems of the sovereign wealth fund, strategic investment fund world is the lack of transparency, the lack of data. Well, if the new funds follow the kind of model I am describing, this problem will be solved, because they are obliged to publish what they do. They are obliged to have a full transparency. So these are the kind of things I see from the work I am involved in. I think it's in a way quite exciting to see this happening. And it probably links within the overall movement that post-COVID, the recovery will be green or will not be. Therefore, those funds, in our view, can contribute in a significant way in crowding in private investment into green projects as part of the post-COVID new reality. Thank you.
Thank you, Michel. That's very useful. And I think we're going to be seeing a lot more of strategic investment funds being established in the next few years. We had one question from the audience, which says, how do you see the sovereign wealth funds changing post-COVID-19? Will they tighten their requirements, eliminate certain sectors, cap investments, etc.? Geoff, would you like to take this one, perhaps?
Well, along the lines of what I mentioned before, it really varies with the sovereign wealth fund. So I think there is going to be, as was pointed out, there are going to be some definite changes in investment strategy. Clearly, VC and technology investments are exciting. And it's now apparent to everybody about how valuable they can be with the incredible valuations of some of the US technology companies. So there will continue to be motion in that area, but that's for sovereign wealth funds that have lots of assets and are not under pressure. There are sovereign wealth funds which may be forced to become more conservative because of the liquidity needs. So they're going to have to decide on a sort of case-by-case basis what to do. The other factor is some sovereign wealth funds are purely for wealth generation, are looking at total return, and it's irrespective of where the investment is. It's just what's the best deal. Other sovereign wealth funds are a hybrid, and they're also looking to help the domestic economy and invest in sectors that need financial assistance. So certain sovereign wealth funds post-COVID will be focused on that. How do you deploy resources both to make money and to develop the internal strength of the country and rebuild because there's a lot of economic damages that's been done in various sectors. So money will also be channeled in that direction.
Absolutely. I agree. And I think the mandate has become paramount and is very important to be defined in the establishment of the fund. We have a second question that reads, any thoughts on what role global investment banks should undertake when advising public investment funds? It seems that global investment banks are playing too much role given the lack of expertise. Perhaps Mr. Al-Tamimi, would you like to comment on the role that investment banks are playing or will be playing in Kuwait in the foreseeable future?
I did not get the question. Could you repeat it, please?
Yes, it's regarding the role that investment banks play with the sovereign wealth funds. So obviously we have seen cases like the Goldman versus Libya, and other cases where investment banks work very closely with the sovereign wealth fund. What's your view on perhaps the role that investment banks are playing in the Middle East?
Well, this concept of investment bank is not really well established in the Middle East as it is in the United States or Europe. But I believe that investment bank could advise the management of some of those sovereign wealth funds how to utilize the liquidity or the funds which they have. But as we can see now, there are certain sectors that are that make very good opportunities for investment, particularly the technology sector, the health sector maybe, and I think that also there are maybe some possibilities in infrastructure or education, but there are also sectors that we have to be cautious with, especially hospitality, airlines, and I don't know how those funds are really allocated. As Dr. Naqshbandi mentioned, that there is a lack of data, and I believe that maybe as you raise the question, investment bank could be helpful in the coming months and years, helping sovereign wealth funds.
Thank you, Mr. Tamimi. Yeah, if I can add my 2 cents. I mean, if you read the Goldman versus Libya case, they refer to Libyans as dumb money. And I think that will not be the case anymore. The sovereign wealth fund industry has evolved significantly and is now quite sophisticated. So we'll see that changing, I think. Okay, so on to the next question, and it's for Michelle. Could you speak a little bit more on the intersection between rising levels of debt in African countries, including some of them with sovereign wealth funds? And does the profile of the debt matter? And could you comment on how some of these countries in debt distress are interacting with their sovereign wealth fund?
Thank you very much for the question. Honestly, I have not been studying these cases. Okay, I have not been involved in studying the relationship between debt and sovereign wealth funds in existing sovereign wealth funds, since my entire work over the past months has been in the development of new funds. In general, a lot of the countries that we deal with need to improve their asset liability management. So you need to, first of all, establish a strong state-of-the-art asset liability management framework, which is largely non-present in many of the countries in Africa. And once you have this asset liability management framework in place, then you can begin to take, considered decisions about the relative role of debt versus investments by the fund. One of the precedent panelists has emphasized the importance of a very close coordination between the government macroeconomic and fiscal policy and the policy of the sovereign wealth fund. So this goes to the heart of it. It has to be, in a way, the management of the sovereign wealth fund has to be an integral part of the asset liability management of the country. It cannot be seen as a separate. But once you have this asset liability management framework well in place, then you can begin to make, I think, rational decisions about the optimum deployment of the fund. I think that the proposal by Mr. Davis concerning the use of the sovereign wealth fund as a possible source of borrowing, including borrowing securitized by some of the fund assets, is an interesting one. And again, we always come back to the central point, which is that you need an economy-wide asset liability management system involving government, fiscal, government debt, the sovereign wealth fund, both in terms of investments and debt if it decides to be leveraged. But personally, I have not been involved in the establishment of such ALM systems in Africa in recent months.
Thank you, Michelle. Now we have time for one last question from Mr. Harrison. Rather long question, but it's basically around the Dutch disease and how how it helps with the mission of sovereign wealth funds or it doesn't. So the question goes, what does the panel see as being the best practice model for addressing issues of mandate legitimacy, contingent drawdowns, debt rising, and sovereign wealth fund potential role in stewardship of domestic government-sponsored investment initiatives? Archana, would you care to take this one?
Oh, it's a long question. I think Michel wants to answer it and I'll let him in a minute. I read a little bit of the question and read about the commentary that, is it the Dutch disease? Perhaps maybe, in the younger oil-backed smaller countries, maybe that exists. But if you look at either the Singaporean or the Australian sovereigns, which have also been created with certain thought process in mind, they have had proper processes and rules and what they would intend this sovereign wealth fund to be used for. Even in recent times, we know that the Singapore government asked the sovereign to help out in making sure that the infrastructure asset companies within Singapore did get help from the sovereign for the right reasons and not just as something that was connected to the Prime Minister's office or the family, etc. So I think there are some which are addressing that properly and some which are newer will over time get to do that. Michel, you wanted to say something.
Oh, thank you so much, Arkinia. No, what I wanted to say is that until a few years ago, the general theory was that the optimal allocation of a sovereign wealth fund resources should be full investments abroad. And the typical example of that, of course, is the largest sovereign wealth fund of all, which is the sovereign wealth fund for Norway. But it was then shown by quite a literature, actually. It was shown that while this is true for a rich economy, this is not true in an economy which is an emerging economy and where current generations are poorer than future ones. In a situation like that, which is the situation in a large number of countries that we deal with at the World Bank, now the consensus in terms of macroeconomic policy has shifted to dynamic general equilibrium models, which seek to achieve an optimum allocation between foreign savings and domestic investments. And actually, both the IMF actually and the World Bank have implemented such models in quite a few countries and have advised governments as to the optimal allocation between these two. And these models come out with I think, a solid framework to justify an optimum allocation of some of the resources of the sovereign wealth funds to domestic investments. And that, I think, is probably part of the response to the question of how you manage the potential impact of Dutch disease on fund management.
Thank you very much to both. And thank you for the whole panel. Unfortunately, we are out of time, but I want to thank you again for your participation and to the American University for hosting such a great event.
Thank you.
That concludes panel A. At this time, we will pause our program for a brief break. The program will resume at 12:55.
Okay. Can everyone hear me?
Yes.
Perfect. Well, I'd like to extend our deepest gratitude to all of our speakers for the 7th Annual Sovereign Wealth Funds Conference. It is with great pleasure I'm here to present the moderator of Panel B, Mr. Michael Madwell. Mr. Madwell is the president and chairman of the Sovereign Wealth Funds Institute, which provides research and data to a variety of clients, including investment banks, asset managers and owners, private equity, law firms, universities, governments, and corporations. He received his master's in investment management and financial analysis from St. Mary's College and a bachelor's in finance and risk management.
Thank you for the introduction, and I'm very excited to be moderating this panel. Important topic, sovereign wealth funds post-crisis. I'm going to introduce, or actually I'll have each panel introduce themselves going down the list here. So first I'll have Dr. Wilmot Allen, who please give a brief introduction, and then I'll go through each one.
Thank you, Michael. I also want to thank the Kogod School of Business, Dr. Naqshbandi, for this invitation. This is, I think, my 3rd time participating, and grateful for the opportunity again. I'm Wilmot Allen. I'm based in Nairobi, where I work in private equity. I'm also a researcher with the Wits University, the Africa Center for the State of the U.S. I research sovereign wealth funds primarily in Africa and the Middle East, and that research and my publications are now focused on sovereign wealth funds as drivers of economic development through transaction-based development, through direct investment in firms and other related activities. So very pleased to be with you. Previously, I worked with the IFC. Before that, I should say I worked with the USAID Enterprise and a transaction advisory firm from the US, running the East Africa Trade and Investment Hub, and also worked with the private equity team and infrastructure teams and financial institutions teams at the IFC. Thank you so much.
Thank you, Wilmot. Mr. Babak Hafizi.
Hi, everybody. It's a pleasure being here. Thank you, Professor Naqshbandi. Thank you, Kogod. My name is Babak Hafizi. I am a investment banker and a consultant. I work with both sovereign wealth funds as well as private investors that are looking to structure and raise money both domestically and internationally. So I've been quite involved in the venture capital field. I've been involved in structuring hospital systems throughout China and now in Kurdistan. So it's a pleasure being here. I'm also a professor, adjunct professor of international business, at Kogod as well.
Thank you. Kareem, will you introduce yourself, please? Sorry.
Can you see me?
Yes, I can see you.
Wonderful. Yes, my name is Kareem Naqshbandi, and I'm the founder and CEO of All Compliance Services, which is a cybersecurity and RegTech technology software company. And the preceding 12 years before that, I was an investment professional across the capital stack.
Excellent. And last but not least, Dr. Timothy Tamura.
Hello, everyone. And I would like to extend my thanks to Professors Naqshbandi and Harris for kindly inviting me to participate on this panel, as well as for their mentorship during my tenure here at American University. I'm a relative new person in the academic world, having come out of the professional investment space, where I served as an institutional investment manager for approximately 35 years.
Well, we have quite a diverse panel here, people from all over the world, all different professions. I'm very excited to jump in this topic. And again, I want to thank the American University for having this 7th conference here. So our topic is post-crisis sovereign wealth funds. How are sovereign wealth funds, sovereign development funds dealing with, or could be dealing with, after we're out of this crisis, right? I mean, we're still getting breaking news about new outbreaks here and there, but we're kind of getting a sort of sense of what it's going to be like in the 6 to 12 months. So I guess the first question that I like to bring out is, what are the impacts for sovereign wealth funds post-COVID? Because a lot of wealth funds get their wealth from oil and gas and natural resources, right? And the price of oil has definitely gone down. It's gone up a little bit, but it's been really at this stuck point. Dr. Wilmot, do you have any insights into that on your interpretations of the sovereign liability and how wealth funds can cope with this in a post-COVID world?
Yes, it's interesting. In 2007, 2008, there was an interesting article in The Economist about the invasion of sovereign wealth funds, how the sovereign wealth funds were coming to bail out US institutions. And now we're seeing, in a different way, global support being given to sovereign wealth funds in light of this pandemic. Obviously, many of the sovereign wealth funds in terms of liabilities now are stressed. But from the vantage point of Africa, what I can say is this, is there has been more of a doubling down of domestic investment here on the continent of Africa. I think more sovereign wealth funds on average invest domestically as part of their formal mandates than elsewhere internationally. And I think that's what you're seeing in key sectors as it relates to pandemic, such as healthcare. Obviously, the governments here are very much stressed in terms of their budgets to allocate public money to such efforts. And so we're seeing the importance of sovereign wealth funds in healthcare. And if you look at the Nigerian Sovereign Investment Authority in infrastructure, because of the challenges supply chains are faced with during this pandemic. And we're seeing now more of an interest in firms that maybe do not have natural resource endowment as most sovereign wealth funds do in Africa, and starting funds because of the security blanket, if you will, in the times of crises like these. So I think sovereign wealth funds are taking on a deeper role as actors in economic development as never before in this post-pandemic world, especially here in Africa.
I mean, we've seen a lot of the emerging market sovereign wealth funds have to get depleted in some instances to help pay for some of these pandemic costs. And just going back, we got news that Mozambique is contemplating a sovereign wealth fund. The central bank recently released a kind of white paper on it. And then I just was in a previous Zoom meeting with the Sovereign Fund of Egypt, which is also looking to expand and grow. But Bach, what are some of your insights in this area? Do you have any opinions?
Yeah, so to me, it's quite interesting. I think that we have actually not, we have not gone through the full scale of the COVID crisis on the balance sheet of sovereign wealth funds. If you look at, for example, real estate holdings that they have, those are still, those are going to be damaged in the next few quarters. Those valuations will come down because cash flows are coming down. If you think about commercial real estate, which is a very large holding of sovereign wealth funds, that is something that right now commercial real estate is underperforming. There's a lot of people who are not paying leases, and those valuations are going to come down. So I think that we're still in the middle inning of really figuring out what the damage of coronavirus is going to be through the valuations of sovereign wealth funds. And whereas we have seen the first phase of it, the latter phases are still going to come, and it's going to be everything from commercial real estate to even healthcare valuations that may come down because of this crisis amplifying the cost of providing healthcare to specific individuals. So we're going to still see write-downs coming through. So we are just in the middle of it all. And I think that a lot of sovereign wealth funds are playing offense and defense at the same time. They have to. They have to look at see where the opportunities are to kind of hedge against where their risks are going to be in the next 2 or 3 quarters.
Real estate's a very interesting area, as we know that more people are remote. And I always talk to a lot of my clients, banks, law firms. Are people coming back to the office, and are you going to renew the lease or shrink the lease? And a lot of institutional investors, sovereign wealth funds, are heavily exposed to real estate. And at the same time, we've seen logistics and e-commerce gain traction. A lot of wealth funds are putting money in that, kind of looking at student housing, contemplating. Timothy, you were an allocator or worked in the investment management space. Do you have any opinions on real estate and other areas of this post-COVID world when it relates to sovereign wealth funds?
Yes, thank you very much for the question. When I was invited, I sat back and thought about what may be the issues in the investment space that kind of bubble to the surface. And I came up with 3 areas that I think have some interesting futures because of the implications of the environment that we are currently going through. The first is and I hate to start any sort of commentary with a 4-letter word, but it's risk. And I think that there's going to need to be a renewed focus on risk-adjusted returns. As an academic, I realize that these risk-adjusted returns are time varying. And at different points in time, they're relatively attractive, and other times they may not be as attractive. The interesting thing is that I don't always believe that being a long-term investor is simply the easy answer to some of these questions, because I raised the issue, and I think a lot of the folks here on this conference will kind of remember the Nifty 50 in the 1970s. And it took a whole generation for returns to be gotten back. I think what also is going to be interesting when it comes to risk is that what we have kind of known and come to understand as diversification is going to change a bit. And I think there's going to need to be a renewed focus on diversification. And the reason I say that is that a lot of the new investment areas that are being invested in, I think have higher correlations with each other than I think people may initially believe. The other comment about risk is that I can't help but think of a text that I have my students read for me each year. And that is Charles Kinderberger's Manias, Panics, and Crashes, and his discussion of how liquidity impacts markets post some sort of economic dislocation. So I think there's one aspect that's going to come from a changed risk environment. The second's already been discussed on a number of levels, and that is liquidity. And I think what was easy before in managing liquidity, and I'm talking about now several decades back, was that cash wasn't as trash as it is now. And the interesting thing is that having any sort of liquidity is really going to be a drag on long-term returns. And the third issue that I want to bring up that concerns me, and I'm trying to get past it, and that is how we can get higher than low single-digit real returns into the forecastable investment future. And what to do about that, and where to potentially look to get a boost for returns without unnecessarily increasing risk.
And very good. I mean, it's if you read any annual report from Sovereign Wealth Fund, they're always kind of pessimistic, right? They're like, we're in a low yield world, negative interest rates, a certain amount of bonds, a large percentage of bonds out there by Bloomberg says that have negative interest rates. Mm-hmm. And so they're just stuck with, what do we do, right? Do we just buy more and more stocks? And that's kind of been the thing. I mean, we saw the Public Investment Fund of Saudi Arabia go in and make a bet and buy a bunch of stocks, made some money. But going forward, what do we see going on here? And a lot of people are paying attention to what the central banks are doing, how they're coordinating action, how they're looking at swap lines. Can they get money to these different parts of the world where people might need to refi in US dollars. So now we're talking about risk, right? So Kareem, kind of COVID related, but we saw 1MDB, major scandal, and the unraveling. It brought down an administration in a country. Can you share some insights on some of the risks you're seeing in this post-COVID world? Kareem, I want you to chime in here.
Yeah, no, absolutely. A great point. I think that particular settlement really, and that's one of several that are in the process now, it really brings to light the importance of a culture of compliance and compliance systems and monitoring processes, which is the other end of returns, right? It's risk return. As Dr. Tamura just mentioned, I definitely believe that the future post-COVID world is all about managing and mitigating risks and adjusting expectations for the risks. And I think we have a lot of different emerging technologies that make it possible for the first time to be able to extract analysis and insights on the same data sets that sovereign wealth funds have had access to, but have not really utilized to their advantage.
Yeah, I think the whole, I mean, just from our own company standpoint, we're seeing a lot of people interested in KYC and anti-money laundering and knowing who the counterparties are when you're engaging in a transaction. So let's switch from risk to returns, and let's talk about how can sovereign wealth funds make money? How can they generate these returns? You know, some of them have different liability structures, but going forward, what are some areas of opportunity that you're seeing that these sovereign wealth funds can take advantage of? So I'll go back to Wilmot here. Wilmot, do you have any ideas you want to share?
Sure. I'll start with where I ended, which was healthcare. So I think one thing we're seeing, so another hat that I wear is as venture partner with the private equity fund that invests in healthcare. And what we see is that there's interest now in sovereign wealth funds considering parallel funds or parallel vehicles on side of other structured vehicles for that the GPs are managing in order to mitigate risk by allowing others, for example, who know the sector better, who have the capability to do more efficient diligence because of that. That's the way I think some of the smarter funds we're seeing on the continent here position themselves, I think, to invest in potentially high growth sectors. And in healthcare, it's long-term high growth. But the other thing is, someone mentioned this before, I think on panel A, venture capital. We've seen that in China. I think there's maybe 17 billion in VC deals this year. And again, I think what we're seeing happen is that these funds are now looking for new co-investment partners, looking for new ecosystem partners, whether that's Accelerator. I founded a company called Venture Lift Africa, which connects African businesses to diaspora resources. And we're in conversation with the Sovereign Wealth Fund about helping them source SME investments for early stages. They think about their VC strategy. And so looking for these new niche areas, niche in a sense, and sub-Saharan Africa, it's new. I know globally it's not a new asset class. Venture capital, that is. I think it is a smart way to do it. And then I think looking for ways to de-risk investments by participating in sort of structures and mechanisms where there are guarantees and there's leverage maybe to balance out the equity. By that I mean on the continent here, probably the most exciting policy initiative is the Africa Continental Free Trade Agreement, which is going to really catalyze inter-Africa trade. And so a lot of that money, new money, is going to have to come, yes, domestically, and there aren't enough, in my estimation, funds, private equity funds that are going to be able to fund that. So I think there are going to be other asset owners that are look to really support that. And there's a whole policy framework to actually support that now, loan guarantees, et cetera, et cetera. And so we're seeing the shift in, again, sovereign wealth funds going deeper in investing domestically and find out there's more support for that so they don't have to really go it alone.
Excellent. Yeah, I mean, we've also witnessed a lot of stuff in the fintech space and how payments are transferred, a lot of opportunity there, and a lot of wealth funds are looking for partners, local partners, because I know a lot of the larger private equity funds went in Africa and had a really hard time. So they have to rejig, hey, let's look at these local African PE firms that have a greater pulse to what kind of deal flows going on. And it's something we are definitely witnessing too. Babak, you banker. So what are some of the deals that you're seeing, or what's kind of coming down the pike?
Yeah, so I think one of the things that we have to really be cognizant of is that it really depends what kind of sovereign wealth fund you are and where in the world you are, because your strategy is very, very different and your objectives are very, very different, right? So one of the things that we're seeing is that if you are from certain countries that require jobs domestically, you're starting to see that those sovereign wealth funds focused on domestic investment, at least moving a portion of their investments into their own domestic markets and investing in that market as a growth vehicle for producing both jobs and wealth within the home country rather than internationally. However, for many sovereign wealth funds, China still is the primary investment market. I think that one of these stories that is not very, very well covered in the Western world is Jack Ma's new company, Ant Financial Services, which has had investment by both Temasek, GIC, and Mandibala, and it will be doing the largest IPO in the world, both in Hong Kong and Shanghai in the coming few months. It will be worth about $250 billion when it IPOs. And then if we juxtapose that with, for example, Alaska is collaborating with they're outsourcing their investments through Silver Lake Partners or other organizations, through 4 or 5 other investment vehicles that are looking for seed, Series A and Series B, and buyouts. So they're actually diversifying their entire portfolio in alternative investments in a way to really get access to the private markets, and to be the banker to bring to be the investor to bring those companies public. So we're seeing a lot of those activities. So again, it really depends on what your investments are. Just one other element, for example, an investment, a sovereign wealth fund like Iran's, is focusing on 2 companies domestically. DigiKala is one of them. It's basically the equivalent to Amazon, and Cafe Bazaar, which is an Android, it's a Persian Android store, like an Apple store, very similar to that. And so they're really focusing on domestic innovation and being that seed and Series A capital there.
I know we are witnessing a sort of talk about China, and a lot of sovereign funds and even pension plans have exposure to China with Alibaba and all these other stocks. But the question looms is what's going to happen in the next 2, 3, 4, 5 years in terms of the bifurcation of the Chinese internet and the US internet. And we saw with ByteDance, TikTok, the unraveling, the White House is battling that. And are investors prepared to have more regulation coming up? We're seeing a rise of protectionism. And this is no secret here, is that, there have been allegations on both sides of, trade wars and, technology and intellectual property theft, and all these things are all coming up. So how can investors navigate this? Because, let's say TikTok, all of a sudden, TikTok is worth all this money, but it could be worth nothing if they block the deal, right? So that's sort of the thing I think a lot of sovereign wealth are thinking about, but yet they are playing both sides. They are heavily investing in the United States, and they are heavily investing still in China. Let's go, Kareem, I'm going to go with you, and then Timothy. What are some of the risks of investing into China and in the US and kind of this cross-border play here? Maybe just any opinions that you would want to share with this group.
Yeah, sure. So I've done several different cross-border transactions, and the trick to a cross-border deal, I was on the buy side as a principal investor, is if you put your money into something, you have to be able to get it out. And with a lot of competition in that market, being able to get the right price to deploy that capital into China, into something that is not problematic, and then get your money out, is, I think, the primary concern of US-based investors. For foreign investors, I think it revolves around who else is sitting at the table. So it's strategic capital. It's not just capital chasing returns.
Yeah, we've seen that these bilateral funds. China the CIC just inked a deal with an Italian, with a European fund manager to bring Italian businesses into China. So having that kind of leg really helps. Timothy, I'm gonna jump to you now.
Sure. Thank you very much. I'd like to address the question of, well, where should they invest? And again, what is the logical conclusion, I believe, from some of what I had spoken of before? I believe that a lot of the financial engineering returns will slowly dissipate over time. And I think we see evidence of that now. And so I think a lot of the financial engineering strategies are going to have to give way to something else. And I think that something else is real economic growth investment within the country or within the region. And I think that that is going to enable the sovereign wealth fund to contribute to the economic growth, the productivity, the diversification of the economies. And I think there's going to be a lot of positive benefits from those direct investments, again, within their countries or within their specific regions. The other thing when it comes to investing in some of the public equities, I don't believe necessarily that the outsized returns relative to other managers are going to come from the passive space. I think that there are better opportunities to pick select companies, take significant positions in those select public companies, and then develop, as some of the panelists have suggested, co-partnerships or partnerships, again, within their country or within their region. See, I think that that then allows you to focus on some of the ecosystems, again, to use Dr. Allen's comment, that include things like education and healthcare and technology and transportation. And again, to have a focused, real economic growth strategy.
I don't think a lot of the credit funds are going to want to hear that, but yeah, it's something where I think there is a lot of, we're seeing in the news today, a lot of companies that were highly levered are going bankrupt, partly because of the lockdowns, obviously, but they're highly levered. And that these private equity owners have been pulling out dividends and draining the company. And so I think there is a sort of long-term speaking, how can wealth funds take advantage of this? And I think you're right, absolutely investing into the real economy, but that also brings challenges. I mean, like I said earlier, is that finding the right partners, this adventurism can be really dangerous. I mean, I've heard of stories from sovereign wealth funds off the record that they went into a country and then was really good. And so I think forming these kind of partnerships on a government level, also on a business level, are really important. Dr. Allen, you talked about healthcare. Let's kind of jump on that again, and because this is kind of a COVID talk in terms of the post-COVID world. How do you, what areas of healthcare do you see sovereign wealth funds investing into? You think you see more wealth funds going the pharma route, trying to bet on this different vaccines, different kind of cancer therapies, or more of the diagnostic health, health tech, making health more, cost efficient? Oh, you're on mute.
Sorry about that. Thank you. I think it's a third option, and that is infrastructure. Because of, well, it depends again where you are in the world. I think I said before, my purview is really, and perspective is really going to be focused on sub-Saharan Africa and North Africa as well. But I think in this part of the world, it's definitely infrastructure. I was a management consultant to the African Union CDC and helped write their plan for a new COVID response institution called the Africa Public Health Foundation. And during that time, during the research, it really became apparent how fragile the healthcare ecosystems are across the continent. And so I think the first order of business is really healthcare infrastructure. There isn't a lot of money, as much money in primary care as there is acute or specialty hospitals, but that has to be, I think, the focus. And then to your point, manufacturing, whether that's pharmaceuticals, healthcare equipment, devices. That is certainly, I think, an underserved area across the world now in light of this pandemic. And then I also agree with you on medtech. That will really push the envelope, particularly now we're seeing a major push. The Gates Foundation, other institutions around the world just announced this new initiative on genomics and precision medicine, which is going to be the future, incorporating AI and blockchain, and using new, most importantly, diversifying the subjects that are participating in trials. And so I think to the extent that, you know, different countries can have their own capabilities, I think that's going to attract investment. Again, it's going to be co-investment. In most places across the world, there aren't many healthcare focused funds. We know, I think those who have been studying PE funds know that Abraj, with the sort of demise of Abraj, that's opened things up across the Middle East and Africa with regards to healthcare investing. So I think there's a gap, and I think that sovereign wealth funds will be looked to help fill that gap, beginning with infrastructure, going to other asset classes and other sectors, subsectors of healthcare.
You mentioned Abraj. Before I jump onto another topic, Kareem, do you want to talk about Abraj at all? Because you're the compliance KYC person.
Yeah, no, I don't. But what I will say is that for the first time in my 20 years as a professional investor, hearing that impact investments will yield a higher return than a normal investment is groundbreaking, a huge shift from all the previous years of when you would expect an impact investment to yield you a much lower return. And that is not the situation anymore. So I just wanted to make a note of that.
Excellent. Yeah, I mean, the advent of environmental, social, and governance concerns, I've never seen this. And there's definitely a whole groundswell here, and the classification of green bonds and the central banks acknowledging green bonds and even including, I think we'll just see it grow more and more as green bonds have more debt and the benchmark increases, and then it becomes a sort of normal thing. Yeah, and we're seeing a rise of different private equity vehicles. TPG has the Rise Fund. There's all these impact funds going out there, and they're trying to find these investments where they can make a difference, but they still have the laws of economic gravity play out. It's still going to make money. Babak, do you have any insights onto impact investing? Anything else?
Impact investing is obviously a very, very hot topic. I do believe that still today, the definition of impact investments and what it really means to be an impact investor is still, prone to what an organization wants it to be. I still think that we need to create benchmarks for that and really make sure that, we're comparing apples to apples throughout the investment portfolio. But I want to just going to say that, yeah, so there's two things I want to say. Number one, in China, I do believe that, yes, China possesses an ability to limit the amount of money that you take out of it and the uncertainty of that market. But we have to also not forget that during this entire, TikTok issue, two major organizations moved their offices from Hong Kong to Shanghai. One was JP Morgan, the other one was Vanguard. They moved more than $6 trillion worth of money into mainland China, right? So if that does not tell you where those two organizations are from a risk perspective, I'm not sure what else will, right? And China is investing heavily in private healthcare. One of the projects that I was involved in was to bring American-style healthcare systems with American doctors into Nanjing, China. And China is actually moving from a public healthcare system, which is about 80% of their current economy, to move that to about 60%, and bringing 40% of their healthcare to become through private sector means and at global standards. So I completely agree that in specific markets that have been underrepresented in the healthcare sector, the infrastructure of hospitals and medical schools and nursing schools and all the peripheral second derivatives that are associated with it are going to be huge. In the developing world, we're going to see that through private investments in biotech and genetics and those kind of byproducts of improved health sciences. The other element that also we're seeing a lot of investments is in materials with food security. So sustainable farming, being able to grow food somewhere, different places around Earth. And we're seeing massive amounts of investments in those areas as well to increase food security throughout the world.
Yeah, and like I said earlier, healthcare is an area where, man, it's just, there's so much opportunity, and with all the technology and how fast that they can advance drugs, and even looking at all the vaccines are coming out. You have the Russian direct investment fund going on their angle with the Sputnik vaccine, and then you have Trump with Regeneron out in the news, right? Let's now we're open to Q&A, questions and answers. So we have some questions coming in now. This one is a question that I'm going to say right now. So the question is, how confident is the panel that sovereign wealth fund investments will be properly benchmarked in terms of risk, return, and tenor? For example, implicit policy subsidies are being explicitly costed, and that the apparatus and expertise exists to handle them. And then he says, the lemons tend to ripen before the plums, and one would not want long-term investments to have started out as short-term ones. So does anybody want to tackle this one first?
I'll start. Look, from the African vantage point and its diversity, I would say this. As we see this evolution from the way sovereign wealth funds have traditionally invested to now co-investing with new partners, obviously sovereign wealth funds will have a lot more money, but they don't have the track record and experience. And typically the structure of the deals are going to be dictated by funds that have more experience and are more seasoned in an asset class. And so I think that is going to help sovereign wealth funds in terms of the benchmarks, the strategies, and even governance as they co-invest with institutions that have a long track record and are susceptible to greater accountability and transparency than sovereign wealth funds. The other thing I think is interesting is this, and I haven't done a study on this, but I think this is probably evident even before, even over the last several years, as we've seen this pivot to direct investing by sovereign wealth funds, is that I have seen in small, again, I don't have a lot of data points in this to make a firm argument, but I would think that sovereign wealth funds now are diversifying their management teams, right? Bringing in new people with different experience in different asset classes who can have, so that expertise can be more in-house. And along with that comes, a certain way of doing business, a professional socialization. I'll give you a good example. The Nigerian Sovereign Investment Authority, Uche Orche, Harvard Business School, Goldman Sachs came to run that fund. And so you see a lot of that happening now. It's not just because of concern of, managing risk and governance, but it's just good business. You need people who have done it with other funds in other places and have the training track record and also the network to be able to do that with sovereign wealth funds.
Anybody want to add, Timothy?
Yes, I just want to add that I by no means wanted to indicate that, well, one thing, that all alternative assets are going to see a decline in return. I mean, there's still going to be those standout opportunities in some niche space. As far as the risk issue, again, I don't mean to also imply that the sovereign wealth funds or any large institutional manager isn't thinking about risk-adjusted returns. I think they all have the tools and the processes in place to address the issue. It's just making sure that you, again, ask the right question and then kind of take the right steps with it. But I think what will solve a lot of the problems with the direct investing or the real economic investing that I suggested, and again, it was addressed here on the panel, is finding the right partners. And with the size of assets that exist in many of these sovereign wealth funds, I think that there are going to be a lot of companies, public companies, maybe even some private companies, that want to partner with those individuals. And so I think accessing those partnerships sooner than later is going to be a real positive.
Absolutely. And we're also seeing a lot of wealth funds partaking in, private investments and public equities. They're finding these companies that need capital and bypassing Wall Street and being able to provide that capital. And as Dr. Allen alluded to, is that they're building their own capabilities in-house. They have former people working on the buy side, and they can hire them and pay them a very good wage, and they'll stick around. And so I think they are competing against some of these private equity funds for these lucrative assets. I guess the challenge today is that how do they access these infrastructure assets that are unique? Because a lot of people talk about greenfield, but they're really cautious on it because there's cost overruns, there's political issues, and so I don't know. So let's. I'm gonna go back to Tim here. He's got a PowerPoint slide that you want to share, Tim. I'm gonna pass it off to you.
Oh, actually, I'll tell you what. My PowerPoint slide has been pretty much discussed. I just wanted to suggest again the risk-adjusted returns added with the liquidity issues that are going to be out there that translate into these real returns that, again, I'm having trouble getting out of the low single digits, point to what may be an alternative, which is this economic growth investment. And so that's all this particular slide wanted to convey. And I thank you very much for putting that
up. Sticking on the theme with partnerships, what sort of, Babak, what would be a good way for, let's say you are a sovereign wealth fund and you're starting to save some money, what would be an ideal way to partner with a country or company to achieve returns? I mean, do you have any ideas on that?
So, I mean, what I'm seeing more and more is, and this has been happening for the past 6-7 years, is that sovereign wealth funds are partnering up with venture capital funds throughout the world, right? Not just domestic, not just in their own home country, but internationally, to go ahead and have access to deal flow. It's very, very hard for a sovereign wealth fund to open up its offices and tomorrow become a venture capital fund. Because one of the things that you need is good deal flow. You need good projects that come through the door. And those you build through relationships, through people on the ground, through really, really being involved in the startup venture community in whatever market you're trying to access. So, so although, for example, Singapore, both domestic and GCI have done a good job, GIC have done a good job in developing their own group internally to go ahead and do direct investment, the majority of sovereign wealth funds are still outsourcing it through other firms, through venture capital firms, buyout firms, to be able to access those markets. Number two, venture capital by itself is a very, very risky venture, right? More than 70% failure rate of your dollars, but you're looking for those unicorns. So if you're investing in there, you're really, really trying to hit that one home run out of your 10 investments, and you're going to lose money. And if you don't have the core competency internally to actually manage this, your failure rate could be 100%, which is not what you want to be as an investment allocator.
Yeah, venture capital is a very risky endeavor, and absolutely agree to your comments on deal flow. Deal flow is really important. That's why you see these tie-ups. I mean, there was a reason why the Public Investment Fund actually invested in the Vision Fund, or invested with Barings in this credit platform, or Mubadala with Silver Lake, because they want that deal flow. They want access to these unique investments, and especially with venture capital, because the technology is always evolving. One things might be really popular now, but a few months from now, they could be gone. We're bumping up to the end of this panel. I want to thank American University, the staff at American University, and all the panelists here for giving us the time to talk about this important topic, post-COVID sovereign wealth fund. So everyone, thank you very much. And I will hand it off over to the staff here. Thank you.
Thanks a lot.
Thank you.
Well, this brings us to the close of our conference. Got some wrap up time to take here at the end. My role every year has been, in addition to some of the organizing and coordinating, is to try to synthesize everything that we talk about in the few short hours we're together every year. And it always amazes me on the depth and the level and the faceted area that sovereign wealth funds bring to the world of finance. I was reminded earlier by Dr. Anthony when he spoke about the virtual imbalance between how many US citizens attend college in the GCC as opposed to the GCC citizens coming to the US and Western organizations. And I was reminded actually of how far we have to go. I was reading a book earlier this year by Stuart Laycock, and it was a book about the UK labeled all the countries we've ever invaded and a few that we never got around to. And it reminded me of the disconnect really that's existed between the Western and the Eastern world. I think in that book, the stature was 171 countries had either been invaded or fought for by the UK out of the 193 UN countries. So 171 out of 193. The world has always been a complicated place. The COVID has made the world an even more complicated place. We've seen the advent of the disease. We've talked about how this presents unique opportunities in healthcare. We've talked today about different aspects and different strategies for the sovereign wealth fund industry to survive and to thrive during COVID and post-COVID. So we didn't get into too much of the opportunity set other than this last panel, but I think that's been the challenge of a lot of investments. I once had a friend of mine who ran for Harvard, ran Harvard Management's part of their endowment fund. And he said it was the best client that he ever had because at the end of the day, Harvard just wanted money and they didn't have any other liquidity demands. And as long as you knew how much they were spending every year and how much the goal of the budget of the university was based on, that was your goal, and that there was never money pulled away and never any liquidity demands from the side. But we always have to balance within a fund, any fund that we're talking about with the financial world, is the immediate liquidity needs, which of course have been exacerbated by the COVID crisis, with the long-term prospects for growth and economic development. And I think it has, in particular this year, sharpened our focus in the sovereign wealth fund community about how do you balance that financial return from these economic returns. And I think Tim's comment in the last panel and the panelists that we had, Dr. Allen as well, looking at sort of infrastructure development and whether those would be providing excess returns, excess risk adjusted returns, I think is also tempered by this problem that we have seen in the news. Of course, Kareem mentioned on the last panel between the 1MDB crisis and sort of the conflicts of interest that you have when you do partner with perhaps less than above board investing partners. So this always reminds me, I guess, again, these different developments of international development, of domestic policy, of economic development, of government policy, of how there's a rash of conflicts of interest, so to speak, in the sovereign wealth fund world that are much more complicated and internally interesting, I think, for a researcher to address. One of the things that I wanted to point out, give a little shout out to what we do at American University every year. Not only do we do this conference, but 4 years ago, Tim Tamura, who was on our last panel, kicked off our first alternative asset course. And we also had Archana Hingorani in our first panel, who has been a visiting professor at American University, and she's taught private equity for 2 years to our undergraduate and graduate students. One thing we're trying to do on campus is to provide sort of the net raw material inputs in the human capital into these areas that are emerging opportunities for not only the sovereign wealth fund world, but the financial community overall. I think Tim talked a little bit about financial innovation, financial engineering, the securitization of credit card assets or mortgage-backed securities and things like that. There's certain ways you can squeeze out, I think, efficiencies from markets that are inefficient. But the more important sort of nuts and bolts of how do you squeeze out better infrastructure gains, or how do we take the politics out or minimize the politics of sort of, do I pay for play? Do I get into the pocket of a politician to get the contract? How do I set up partnerships with sort of these pseudo-government or direct government entities that try to minimize the agency problems in the possibility of maybe taking on investments that wouldn't necessarily have positive NPV, but have something, disperse or diffuse gains for the rest of society. And I just think this is amazing sort of area of expertise and of exploration for financial. I'll reiterate Ria's question about how come there isn't more research in this area. I would encourage, if anybody has access or to promote the provision of data. I did my own research projects back in the early 90s when I started my research career. Basically, I did some work on day trading, and we actually did a paper on day trading before the day trading term was used in the popular press. But one of the reasons we were able to write that paper is we actually visited some firms that were doing that sort of trading. And at the bottom line, we simply asked, can we get some of the data? And we could shed some insight into sort of the aspects and the positive and negative consequences of day trading. And I think the exchanges in the more developed world have been able to try to develop some of these research agendas themselves. And so some of that research agenda comes from this provision of data. I was a visiting economist at NASDAQ from 1999 to 2000, or 2000 to 2001. The New York Stock Exchange used to have visiting economists. And I think every chance we have to interface the academic community with the professional community, with the boots on the ground, so to speak, of people doing the investing, dealing with these agency problems day in and day out, dealing with the political consequences, dealing with the real problems of having hunger, having lack of health care, having real problems of society, trying to be addressed by financial topics and financial professionals. I think the more we can do that or have these interfaces, the better off we're going to be. I want to just take up a couple of notes to try to summarize again, this dichotomy between sort of the developed world and the developing world. I just did a little survey during one of the panels, Googled a few things, and we did a panel I was a former chief economist at the Securities and Exchange Commission in 2017. And when I was there, one of the things we were, of course, advocating for was the investor, to make sure that there's transparency, openness, and that there was information available to investors when they wanted to make investments. One of the things we put together, Georgetown University, just this last spring, at the advent of the crisis, had 7 of us get back together and say, what do you think about, should we shut down financial markets? How should we cope with the crisis at its peak when it was late March and early April? And one of the things in the theme that I had brought out in that case is that no, transparency actually, in any case, for most economic systems, perform better when there's greater transparency. So the more information we can shed on sovereign wealth funds, the more information we can share with each other, which you can share with the world, they actually can develop some positive synergies, I believe, in actually putting out and solving problems, whether it's addressing issues, whether it's healthcare, whether it's just feeding the population. But there's all sorts of things that once there's a need or a visible shortcoming in the market, all of that shortcoming and some of those investment opportunities only come to light as long as there's transparency. So what I did anyway, one of the issues there is I pointed out that the financial markets in the late March, early September, or early April scenario was actually had done a pretty good job of sorting out where we expected problems from COVID. And at the time, I think S&P 500 was down about 25%. But the Russell 2000 at the time was down over 30%. And so right away, there was a market signal there that suggested that small firms were going to have a larger problem. And of course, we've seen that along the lines. We see this in actually higher education. We see a number of liberal arts colleges that don't have the buffer zone, that have a smaller faculty, that have a smaller student body. A large number of those colleges and universities are going to be going under from COVID because they generate a large percentage of their revenue, not only from student tuition, but I think what we've found out from the university standpoint is they generate a large percentage of their revenue from the room and board that they provide for their students on campus. And I think the case of Panama is a pretty good instance. I found it interesting that when we look at the Panamanian fund and how they basically have a mandate to invest outside of Panama because they don't believe that there's enough liquidity in their own markets necessarily, that if a crisis hits like this, that there was enough liquidity to get the money out. And I think this is sort of a key and common theme among all financial markets. And I think it's more sharply exposed perhaps during the COVID crisis. I did want to beg a question, and one of the questions that I had back in late March and early April from a few of my colleagues is, what would you be buying right now? And most people would say, I didn't want to buy that falling knife or catch that falling knife, so to speak. I didn't want to buy anything, but I think that prescient investment opportunities, if there were any, did exist. The S&P, I just looked up today, is up about 7% in 2020, which is a good indication that strong, large businesses, the Apples, the Amazons, and the sort of the equity markets in the United States are doing well. But if I did look for the Russell 2000